lots of you would. How many of you own any investment real estate? Do you know across the country, out of every 100 people with a real estate license in America, how many would you guess own investment real estate of any type, from a rental house to a big shopping center? What would you guess? Out of every 100 people with a real estate license, four out of 100 people. We can't even sell it to ourselves, let alone to anybody else. Now, how many of you know somebody who owns it who wish they'd never seen it before? How many of you know somebody who owns it who in their heart of hearts, if they admitted it, would admit they didn't know what they were doing when they bought the stuff? And what if I didn't know what I was doing and I bought a rental property and I lost my shirt? Do I typically blame myself for that? No. Who gets the blame for that? Yeah, the realtor who sold it to me, or real estate in general. So we need to analyze the property before we buy the property, before we list the property. How many of you know people in the real estate business who've taken a listing on a rental property without really being confident in how it works? Or have you ever dealt with an unreasonable seller, where the seller has a higher opinion of the property than the market does, and you get in this big argument with the seller? No, I want to show you how to analyze this. I want to show you how to explain it to the seller and really talk the talk. And so you all should have the handout and have printed out hard copy of that. Now that's a big thick document, but let me just tell you how that handout is set up. I'm going to be with you all day today and all day tomorrow, morning, afternoon. So 4 different sessions, and that handout that you printed out, the PDF, is all 4 sessions in one. And so it'll make sense as we go through. But so this is set up. It's part of a course. The first part this morning, we're going to talk about how to be a top-notch buyer. Then we're going to talk about this afternoon how to be a savvy seller. Then tomorrow morning, we'll talk about how to price it right, how to put a value on investment real estate. And do you agree with me? Valuing investment real estate is different than residential, valuing a house you're going to live in. Those are two different things, and we'll talk about that. And then tomorrow afternoon, we'll talk about when, why, and how to complete a 1031 exchange. How many of you have done an exchange before? How many of you have done an exchange and when it was all over, you weren't exactly sure what happened? Well, that's okay. I'm going to show you maybe how to quarterback the exchange and why people do it. I want you to relax. I want you to have some fun. We're going to get you 12 hours of continuing ed. We're going to get you your GRI credit, but that's great. That's terrific. But mostly all you have to do is keep your butt in the seat for 12 hours to get those 2 things. I want to raise the bar a little bit and get you some good information you can use right now in the real world. So let's have some fun with this, but you're going to do some of the work. You should have your calculator handy. Any old calculator, doesn't have to be a fancy financial calculator. Any old calculator will be fine. And let your calculator do the numbers. We're going to talk about numbers, and people go, oh, no, I don't like numbers. I don't like math. Let the calculator do the math, and you stand back above the numbers and get the concept. And there are people who are looking for realtors who understand this stuff. And the honest truth is they can't find them. I got a phone call about 2 weeks ago from a guy from Medford, Oregon. He called me up and he said, hey, Tom, can you recommend a realtor in my town who understands what you talk about? And he went on to tell me that he has $750,000 to invest in real estate. So he's going to put that down. He's going to buy $2 million worth of rental property. And he can't find anybody in our business who he has confidence in that understands this stuff. He was upset. He was kind of funny, actually. He said, they keep just sending me refrigerator magnets and recipes. He said, I don't want refrigerator magnets and recipes. I want somebody who understands this stuff. And so I think that there will be, for those of you who really take this to heart, this will change your business life, I hope. And also your own investing life. How many of you know somebody in the real estate business for years and years and years and owns no investment real estate? That's too bad. That's a shame. That's just a shame. So take a look at your handout now. The cover is Nebraska GRI. You see all that, a 4-part webinar, real estate investing and management. And so let's just jump right in. Christy and I have been working together for many, many, many years. I've been coming to Nebraska for a long time, and it's just one of my favorite stops. You all are lucky to live where you live. I live in Wisconsin in a resort area called Door County, Wisconsin. If you look at a map, it's a little thumb sticking up into Lake Michigan. I live in a little village, 351 people in the whole, 350 people. Larry died. I'm lucky to be able to do this virtually and not travel. So that's great. So let's do this. Put your mind in the zone of investment real estate. And when I say investment real estate in here today and tomorrow, I mean almost anything besides the house you live in. Even though the house you live in may be the best investment you ever made, it doesn't qualify for most of what we're going to talk about. Investment real estate, it could be the house across the street you buy and rent out to people. Could be a duplex, could be an apartment building, could be a shopping center. Do you agree with me? A single family rental house is every bit as much investment real estate as the biggest shopping mall in all the land. Could you become a real big investor investing in a bunch of real small property? And the answer is yeah. So we're going to talk about that too. Let's do this. Take a look at your book, and we're going to talk about building wealth. We're going to talk about money. We're going to talk about taxes, and people think, oh, that sounds terrible. No, it's great. Turn to page 3. Turn to page 3 in your book. And think of a rental property. Think of a rental property as a money machine. Why do people buy investment real estate? To make money, right? To make money. And so think of it as a money machine. And let's talk about the difference between earning a living and building wealth. Those are two different activities, aren't they? And two different, if you think about it, pretty much unrelated activities. How many of you know somebody who earns a really good living and has no wealth? Or how many of you know somebody who's earned a good living for years and years and years and has no wealth? It's sad. It's sad. In real estate, people are notorious for earning a lot of money and having no wealth. And you can recognize these people a mile away. These are the ones who come up and say, I remember when I could have bought that property over there for $5,000 and now it's $1 zillion. And the one over there, all I had to do is pay the back taxes. And now there's a shopping mall on it. Well, shut up. It doesn't do any good to talk about it. We've got to do it. And so few people do anything. And if you know somebody who earns a lot of money and has no wealth, in large part, it's because they're concentrating too much effort on trying to earn the wrong kind of dollars. Because true or false, all dollars are not created equal. All dollars are not created equal. They all look the same, but they're not the same. They're all treated differently by whom? Or by what? By the IRS. If the IRS treats different dollars differently, then we should treat different dollars differently. And yet we don't. And so many people are out there slugging away every day trying to earn the worst possible dollars. How many of you know somebody who earns a lot of money and has no wealth, has no money? Well, if that's true, in a large part, it's because they're concentrating too much effort on trying to earn the wrong kind of dollars, because all dollars are not created equal. Here, I'll prove it to you. Take 3 $1 bills out of your pocket. Or mentally we'll do it, and put them in front, lay them in front of you. Here's $1, here's $1, here's $1. They all look exactly the same. They're not even close to being the same. Look at this dollar on my left. That's $1 I got from my job. Look at this dollar in the middle. That's $1 I got from the sale of my primary residence. And then look at this dollar on my right. That's $1 I got from my rental property. All 3 of those dollars look exactly the same. They're not the same. They're not even close to being the same. Which is the worst dollar up there? Dollar from your job. $1 from your job is the worst possible dollar. $1 of self-employed commission, the worst dollar in America. Why? What do you have to pay on that dollar? Federal tax, state tax, Social Security, or self-employment tax. Most of you are self-employed. That dollar, by the time you pay your federal, state, and self-employment tax, that dollar is really a 50-cent piece. Now, I don't mean don't earn those dollars, but those are not build wealth dollars. Which of these is the hardest one to earn? $1 from your job, $1 from your primary residence, $1 from your rental property. $1 from your job, selling real estate. Are you kidding? What did you have to do to sell real estate? Late nights and clients and driving people around and open houses and then driving people around and continuing ed and then driving people around and trying to smile at these people and be nice when in your mind you're thinking, oh, come on, is this ever going to end? Well, here, I'll prove it to you. Do this. Close your eyes and wave your hand over these $3 and say these magic words and watch what happens. Late nights, clients, advertising, faxes. That's okay, but what about those taxes? And look what happens. What happens to that $1 from your job? Well, it doesn't disappear. It's not that bad, but it shrinks. How much? 50 cents. That dollar is really a cruddy 50-cent piece. What about the dollars from your primary residence, the sale of your primary residence? Haven't shrunk a bit. They haven't shrunk. They're looking at you saying, I'm $1. What about the dollar from your rental property? Hasn't shrunk a bit, saying I'm $1. It's quivering a little, but I'm $1. The dollars from our real estate are twice as good as dollars from our job. We ought to be telling people this. And we don't do it. We don't. You're in the business of those two dollars that are real dollars, primary residence and rental property. It's one of the most powerful tools we have, that our dollars are better than their dollars. And people don't think this way. I know people don't think this way. Maybe you can help them a little bit. I used to teach a class at the University of Minnesota on investment and tax. And these kids were seniors by the time I see them. And there's nothing worse than a senior in college, boy. They know everything and they just want to get out of here. And I love these kids. And they would come up at the breaks or before class and they'd say, hey, Tom, what do you think of my resume? Here's my resume. Will you critique my resume for me? And here's what I always said. Here's what I think of your resume. Shred the thing while you still have a chance. No, it's really sad to be in a room full of 22-year-old kids whose goal it is to go out and get a job. I mean, that's pathetic. In the richest country in the world with opportunity abundant, they want to go out and get a job. And it took me a whole semester to turn those kids around. But by the end, there wasn't one of them wants a job. And their parents were so proud. Now, see, you've already broken free of this. You don't have a job, do you? You don't have a job. You run your own business. And your business will absolutely succeed or fail based entirely on your effort and your ability. And so I wanted to see if we can, over the next couple of days, add some things to your business tools that will make your business even better. So we're going to talk about rental property. That's our whole focus for the next 2 days. When I say investment real estate, I don't automatically think of some big shopping center. Don't think of a rental property. Of a rental house. If I'm going to use examples, which I am, and those examples aren't necessarily. You don't sit there and go, well, that rent's not even close in our market. That price, that's not even close in my market. I don't care. I'm sitting in a little village in Wisconsin. I'm not telling you I know your Nebraska market better than you do. I'm not trying to hose you, but I know how this works. Once you know how this works, can you apply this any town USA, any property USA, big property, small property, everything in between? And the answer is yes. Take a look at page 2. Just quickly, page 2. And we should always put in a disclaimer, and you know this, and I'm going to do this in the first section here, and you should do it as you're working with your clients. The purpose of this webinar is to familiarize you with several investment issues, not turn you into an accountant or attorney. We're going to discuss some important tax and financial issues. It's important to make it clear right up front, the presenter, Tom Lundstedt, that's me, is not engaged in rendering legal, accounting, or other professional services. Everyone's situation is unique. So before you or your clients take any real world action, be sure to check with the proper professionals. You can't argue with that, can you? Last paragraph, keep in mind, we are not the accountants, we're not the attorneys. Leave that stuff to the professionals, but knowing the material in this program should help you talk the talk. Once the attorneys and the accountants in your town realize how knowledgeable you are, it's likely you'll get some good referrals because they have clients who want and need good investment property. A good accountant, a good attorney, and a good real estate agent. That's a great financial team. You're going to get some of your best referrals from accountants, attorneys in your marketplace. All right. Now turn to page 3 and let's talk about investment property. Those of you who own investment property, why do you own it? Why do you own it? It's a pain sometimes. To make money, think of a rental property as a money machine. I'm going to turn off the video because I think it's distracting for right now. I'll come back later on. So let's do that so you can see the whole screen. All right. Think of a rental property as a money machine, whether it's a great big property or a little tiny rental condo. It's a money machine with 3 parts. What are the parts? So I'm at the top of page 3. I want you to fill in the blanks with me now as we go. 3 parts. What are they? Come on. What are they? Income, expenses, and financing. Income, expenses, and financing. Those are the 3 parts of the money machine. Which of those 3 parts is important? All 3. All 3 are equally important. If you change any one of those 3, does that change the money machine? Yeah. If you change the income, that's a whole different money machine. If you change the expenses, whole different money machine. If you change the financing, it's an entirely different money machine? What if it's a little baby rental condo? What are the three parts? Income, expenses, and financing. What if it's a giant downtown office building? Income, expenses, and financing. Just the numbers would be bigger or smaller. I have a friend who's in the commercial real estate business in a great big town. And I called him a couple months ago. I said, how you doing? He said, oh, good. I just got a new listing and I sold it the first week. And you know what it was? It was a 110-story office building downtown Chicago. He listed and sold it. So you don't have to feel sorry for him. But the point is, whether it's a 110-story office building in downtown Chicago, it has income, expenses, and financing. Or if it's a little tiny rental condo, it's got income, expenses, and financing. Okay. Now, once you know the three parts of the money machine, you can turn the machine on, flip the on switch, and it'll grind away, and it'll produce 4 financial benefits. Look at the next line down. 4 financial benefits. What are they? Those, come on, talk to me. What are they? Okay, yeah, Mike, good. Cash flow. Income number 1, or income is the first one.
Depreciation.
The financial benefits, the first financial benefit, it's income. It's called income property, kids. There ought to be some income there. And all investment real estate has income. It's just not always what? Yeah, positive income. I bet you know somebody owns a building with negative income. You might be sitting right next to somebody who owns a building with negative. And you might be sitting right on top of somebody who owns a building with negative income. Now, what do we call this? We in real estate, we don't call this stuff what everybody else calls it. We have our own language. What do we call it? We don't call it income. We call it, in parentheses, put CFBT. CFBT. What does CFBT stand for? Cash flow before tax. Cash flow before tax. Income tax we're talking about there. Cash flow before tax. And the market shortcuts a little bit and calls it cash flow. All right, so we have some cash flow. What else? Alicia, I see that. That's good. Appreciation. Call number 4, appreciation. Appreciation. The property might go up in value over the years. Not overnight, but over the years. One of the nice things about real estate is it's a relatively stable investment. Relatively stable. It typically doesn't spike up and spike down overnight. In the stock market, you could lose your money overnight. Yes? Where in real estate, it takes you months. Slow. All right, so appreciation. What else? What tax savings? Call it number 3, income tax savings. What creates the tax savings? Yeah, deductions, but what deduction creates tax savings? Depreciation. Depreciation is a non-cash expense, and we're going to talk about depreciation and tax savings, and we'll talk about what happens when you sell and recapture and all those things. You know what? I bet there isn't one person in this webinar who's depreciating their property correctly. Well, there's one. And I don't mean you're doing something illegal. I mean, you're not depreciating to your maximum benefit. And if you're not depreciating to your maximum benefit, you are wasting the money of whom? Yeah, I'm 800 miles away from you. I can see lying on the floor in front of you money. It's your money. Those of you who own rental property, it's your money. We're going to bend over and pick that money up and put it in your pocket by the time we're done. All right, tax savings, depreciation. And then how about the second benefit? The second benefit's a little more subtle. It always gets shuffled off to the side, but it's a powerful benefit. What's happening? What's happening to the loan? Yeah, the loan's being paid down. By whom? The tenants, I hope. Principal reduction, let's call it. Principal, PAL, principal reduction. The loan's being paid down by whom? By the tenants. Somebody else is buying you that property. How many of you work with first-time home buyers, people who are renting? If you know somebody who's renting, wouldn't you look them right in the eye and say, when did you decide to buy a building? They'll say, no. We haven't decided to buy. We are renting. And you have to say to them what? Say, no. You're buying the building. You're just buying it for somebody else. And isn't that true? I'm not being a smart aleck. No matter where we live, we are buying a building. It's just a question of for whom. How many of you know somebody, a real person, a real human being who's rented the same house for 20 years? Have they not paid for that house for somebody else? Yeah. 4 benefits. Now, some people, principal reduction, some people call that equity buildup. Equity. I think that I would prefer that it's principal reduction because your equity is really building in 2 ways, appreciation and principal reduction. So we're going to isolate the principal reduction part. So income, principal reduction, tax savings, and appreciation. So think of this. What are the 3 parts of a rental property? 3 parts. Income, expenses, financing. right? Once you know the three parts, then flip the on switch and turn the machine on. It'll produce cash flow, principal reduction, tax savings, and potential appreciation. Now, shouldn't we as professional realtors be able to estimate these benefits before we buy the property? Yeah. Shouldn't we be able to estimate these benefits before we list the property? Yeah. Yeah. And wouldn't it be cool if there was like a one-page worksheet that allowed us to do this all on one page? You think, yeah, that'd be great. Well, it's like a miracle. In the back of your book, you've got many, many worksheets. Turn to the investment property worksheet and actually just tear one out. If you've got it stapled together, just tear it out and keep it by your side. And you should, I've got one up on the screen now. This is an investment property worksheet. This is one of 6 worksheets I developed for real estate people. And you'll like this worksheet. This will make you a lot of money. And this worksheet is called an investment property worksheet. And the top half of the worksheet are the 4 benefits, are the 3 parts of the machine: income, expenses, and financing. Income, expenses, financing. Then when you turn the machine on, here, Roman numeral 1, 2, 3, 4, here are those 4 benefits of investment real estate: cash flow, principal reduction, tax savings, and appreciation. And more importantly, how to calculate them. If you just follow the worksheet, it'll be like a roadmap for you. And you would do this before you buy the property. Now, on yours, I've edited it out for space. But look at the paragraph at the top. It says this form is designed to estimate the first year benefits. Circle first year benefits. If you're analyzing a rental property, what year's numbers are most meaningful to you? The first year, these are the numbers we can see. The farther out into the future you try to project the numbers, what happens? How far into the real estate future can you see? Me too. Not very far. What's the real estate market going to be like a year from now, or 5 years from now, or 10 years from? I don't know. You don't know either. And yet, don't you see people do projections on real estate? In CCIM, Christy mentioned I have a designation called CCIM. In CCIM, we did 5-year projections and 10-year projections with an internal rate of return. If you're a commercial appraiser, you know that you are sometimes required to do a 5-year projection with an internal rate of return. In my opinion, it's just my opinion, you can take those projections and flush them, because they're only as accurate as what? As the assumptions you make. If you make stinky assumptions, you're going to get a stinky answer. This worksheet is great. It's great, but it's a perfect example of garbage in, garbage out. If you put garbage in this worksheet, it'll produce a big pile of garbage. So we want to be as accurate as possible. And you would do this worksheet before you buy the property, before you list the property. And so I want to try one. I want to use a real example. And here's where I say, don't sit there and go, oh, that price wouldn't be right in my town, or that rent's not right in my town. I want to show you how this works. Once you know how it works, then you can apply it to any town, any property. I'm going to use a real example. I have a friend here in Wisconsin named Maggie, and Maggie recently inherited money from her grandma. And Maggie called me one day and she said, Tom, I'm thinking of taking some of grandma's money and buying a rental property. Can you help me? Sure. I said, sure, I'll give you my opinion. Well, let me show you the numbers on the property Maggie was thinking about buying. So at the top of the worksheet, let's fill this in. You fill it in with me, please. 409,000. It's a little apartment building. A little apartment building. 409,000 is the cost. Now, is that a good deal? Is there enough information up there to tell if that's a good deal? No. If you can tell if that's a good deal from that, I'll go to your webinar. No, what would you want to know? What's the first thing you want to know? Income, yeah, but what's the first thing? Location, you got to be able to find it, but the first thing. How about the terms? Does it matter if it's 409,000 cash or 409,000 $1 a year for 409,000 years? Those would be two extremes, wouldn't they? Well, this property is available 62,000 cash. 62,000 cash. That means Maggie would have to borrow $347,000. So fill this in with me now. Now let me ask you a question. Does the interest rate on this financing affect the value of that property? Sure does, doesn't it? The greater the interest rate, the more money it takes for Maggie to service the debt, the less money that's available for Maggie. So the financing is absolutely critical. Would you believe and agree with this statement? A good property with bad financing is a bad investment. A mediocre property with good financing can be a good investment. The financing is absolutely critical. Well, this financing happens to be all owner financing. The owner's an old man. He's 50 and he's owned this property a long time and he absolutely refuses to cash out. He wants to finance his geezerhood by carrying back the note. And he'll carry back the note, Maggie, with no balloon payment. He'll string it out till it's paid. But in return for that interest rate risk that he would be taking, he wants a relatively high interest rate. So he's offering this 347,000 at 7% interest. Now you could probably do better than this going to the bank, but you cannot go to the bank on this one. He won't sell it. The payments on this, the principal and interest payments would be $24.50 a month. And that times 12 is $29,400 in debt service, we call that. Debt service is just fancy principal and fancy words for principal and interest. Debt service, $29,400. Now, is that a good deal? Here's Maggie. She's got $62,000 and she wants to invest it in real estate, but she's not sure whether she wants to buy this property or the one across the street or the one down around the corner. So she wants to what? She wants to analyze this property. And when is she doing this? Before she buys the property. So now what does she want to know? Let's say I'm the seller. I say, Maggie, look at this. I'll sell it to you for $409,000 with $62,000 cash invested, and I'll finance the rest. What does she want to know now? What would you want to know? What's the first thing you want to know now? Income. Income. Wouldn't you say, hey, Tom, what's your income? Right? It's called income property. We need to know the income. So if you say, hey, what's your income? What does that mean? What does that mean? Income. What if I say to you, what's your income? Does it mean gross? Does it mean net? See, those of you who are looking at me like, I don't know. You're right. I don't know either. You can't just say to somebody, what's your income? Nobody knows what that means. What's your income? We're going to see here in a minute on a rental property, there are 4 different types of income. And if Maggie says, hey, Tom, what's your income? Could I think she means, what's my income? When she really means, what's my income? When the most important thing of all, though, is my income. So we need to be more specific. So take a look at the worksheet and down, you see down here, skip down a few lines. It says annual rent, the annual rent right here. The annual rent in this property is $67,900. So put that there, $67,900. Now the annual rent is the total amount of income that Maggie would collect if every unit in the building was rented every day of the year at full price. It's the total possible income, $67,900. It includes apartment rents, garage rents, washer, dryer income, pop machine. Do you say pop? Are you pop in Nebraska? You're not soda. You're not soda in Nebraska. Well, this would include the pop machine or the soda machine. No matter what, $67,900. Total possible income, $67,900. Now, if that's true, should she, Maggie, if she buys this property, should she immediately go book a $67,900 cruise around the world? No. Why? What are the odds that property is going to be rented every day of the year at full price? It's not impossible. It's not impossible, but it's unlikely. I know this is unbelievable, folks, but sometimes there's no tenants, and we need to make an adjustment for that. This is even more unbelievable. Sometimes, even if there's tenants, yes, you're way ahead of me. Even if there's tenants, there's no what? There's no rent. Just because you got tenants doesn't mean you got rent. So we need to make an adjustment for vacancy and credit losses. Well, what are vacancy rates today? Well, don't even answer the question. It's a stupid question. I agree it's a stupid question. There's no such thing as a vacancy rate. It would depend on what? What town you're in, what rents you're asking, what kind of property? Could you have 4 corners, apartment building, shopping center, office building, rental house? Could they all have completely different vacancies because they're completely different products? Could you have a different vacancy inside your own apartment building on your 3-bedroom apartments versus your 1-bedroom apartment? Yeah. So you'd have to study the market a little bit. In this case, let's use 10%. Let's use 10%. Now, I'm not saying you should use 10%. You should use whatever's appropriate in your market. But in this case, let's say 10. Let's take 10% out of there. If Maggie gets any of that 10%, that'd be a bonus. Let's not count on it. So we take that away. She's left with $61,110. $61,110, and we call that $61,110 her gross operating income, GOI, gross operating income. Now, if you're not used to using these words, don't worry. We'll use these words over and over. You'll get real comfortable with these words. What does gross operating income mean? Put in words a baseball player can understand. I don't understand gross operating income. I couldn't even figure my own batting average. Or my batting average I could figure in my head, but not those guys who could hit. You know what my lifetime major league batting average was? Lifetime major league batting average. Take a guess. Lifetime major league batting average. Yeah, 200. Lifetime major league batting average, 311. If you add it up, which is how I figure it. I hit 100 3 years in a row, adds up to 311. How else would you do it? Here, now wait, what is this 61,110? This is what Maggie actually takes into her checkbook. This property, this money machine produces $61,110. Now, if that's true, should she now go book a 61,110 cruise around the world? No, might that be a little premature? Because now what's she got to pay? Remember, there are three parts to the machine. Income, all right, 61,110. And what's the second one? Expenses. We need to talk about expenses here. She's got some expenses if she buys this money machine. The annual operating expenses, look at the next line down. The operating expenses include everything besides the debt service. Debt service is just fancy words for principal and interest. Your mortgage payments are not operating expenses. Here's a whole list of operating expenses there. Things like utilities, insurance, repairs and maintenance, management, property tax, all those things are operating expenses. Doesn't it make sense we need to know the operating expenses? I mean, that's fairly obvious. And yet, as obvious as that is, how many of you have ever talked with somebody who values buildings based on how many times the gross income, the cost is, the price is, right? Have you ever heard somebody say, I pay 6 times gross or 7 times gross? What they're saying is that cost is 7 times the gross income. And that's how some people value buildings. What do you think of that method of valuing a building? Good method, bad method? Stinks is a word that comes to mind. It stinks. Is it simple? It's simple, therefore popular, but could you lose your shirt buying real estate that way? It's called the gross rent multiplier. People say, I pay 7 times the gross. Well, you're buying a 3-part money machine and you're only analyzing how many parts? 1. You're only analyzing the income. If you say, I pay 7 times gross, well, what about the expenses and the financing? What about those 2 minor variables? Well, they're not minor variables. Please don't fall into the trap of using that gross multiplier. That's how the amateurs do it. Don't do it. You know what? The gross multiplier method knows it's bad. It knows it's bad. And so you know what it does? It tries to disguise itself. It does. Here's one of the disguises that it takes on. How many of you have ever heard that a rental property ought to rent for a certain percent of its value a month? You ever heard some kind of rule of thumb? Yeah. What number to use? What number? 1%? 1%. Have you ever heard of the 1% rule? The 1% rule says that a rental property ought to rent for 1% of its value per month. And so turn it around. A rental property that rents for $100,000 for $1,000, a rental property that rents for $1,000 a month is worth 100 times that, 100,000. If it rented for $1,500 a month, it's worth 150,000. You've heard that? That's the 1% rule. That's a bunch of baloney. That's just a bunch of baloney. Don't fall for it. It doesn't say anything about expenses or financing. Just forget it. You're going to lose your shirt buying real estate that way. So Maggie says, no, come on. I need to know the operating expenses. Well, here's a whole list of operating expenses. We're not going to go through line by line, but let me just give you the total. This is a real property now. The total operating expense on this property, $27,747. So put that there. $27,747. Now, 2 things I want to say here. One is if a broker or seller or real estate agent or anybody ever shows you numbers on a building that always end in zeros or like 3 zeros, don't believe it for an instant. I know this is unbelievable, folks, but sometimes the seller has a tendency to round these numbers off. In what direction? Well, yeah, the income, what direction? The income up and the expenses down. Don't believe it. And there are brokers around who are notorious for putting out bad operating expenses. They use bad operating statements. They use what year's income? Income. Well, yeah, better than the best. What year's income? Next year's income. Haven't you ever seen an operating statement from a broker that says, well, the rents are this, but they could be this? Well, get out of town. If they could be this, why aren't they this? Next year's income with what year's expenses? Last year's expenses. And it's not going to work like that. And if you're listing this property or you're buying the property, you got to check those numbers out. How would you check those numbers out? What if I was the seller and I said, these are the numbers on my property, trust me? Are you going to trust me? Well, I hope not. How would you check those numbers out? You could see the books, but are there some sellers who don't keep very good books? I don't mean they're crooks. I just mean they don't keep very good books. Are there some sellers that keep really good books? Are there some sellers that keep such good books? They keep several different sets. You know, books, I got books. You don't want the seller's books. If the seller's a rounder, where's the seller rounding the numbers in just the opposite direction? To whom would the seller round the income down and the expenses up? To the IRS. To the IRS. Much of this property is sold contingent upon seeing the seller's what? Yeah, tax return, but what schedule? Schedule E. Schedule E is nothing fancy, but I would write that down. Any of us who own investment property file a Schedule E every year for every property we own. And it's on that Schedule E where we report the income and the expenses of our rental property. Should I be offended? Should I, the seller, be offended if Maggie, the buyer, asks to see my Schedule E? No. Is she asking to see the income from my job? No. My personal deductions? No. Just the income and the expenses on this property. And should the numbers on my Schedule E be darn close to these numbers? And if they're not, should there be a ready explanation? Yeah. Here's the Schedule E. Here's the Schedule E. You can have up to 3 properties on one Schedule E. So here's property A, property B, property C, and here's your expenses and your rents received, income. And if for some reason I didn't want Maggie to see property B and C, you could cover those up. But if the seller's around her, what's he telling the IRS about income? Income, I can't rent this credit building to anybody. And then how about the expenses? Everything they can think of goes in those expenses. And so you, as a buyer, want to be sure to check these numbers out. You, as a listing agent, should have the Schedule E in your file when? Before you list the property. If you have a rental property listed and you do not have the Schedule E in your file right up front, come on, you're really not doing your job. Your whole reputation is at stake here. And you want to be as accurate as possible. How many of you ever looked at a building and the numbers on the building turned out to be far different than those represented by the listing broker? Ooh, that's not good. That's not good. Look at your MLS. Look at the investment real estate for sale in your MLS. Usually those numbers are not very accurate. And I don't mean somebody's trying to cheat specifically, but they're just not. You want to be as accurate as possible. This worksheet's great, but garbage in, garbage out. We don't want to put garbage in this thing. Now, typically how this is done is no buyer is going to call up the seller and say, hey, send me your Schedule E. The seller's going to say, go jump in the lake. Typically how this is done in the real marketplace is the listing agent has the Schedule E. So when you're listing a property, you want to say, I need your Schedule E. If they won't show it to you, something's fishy. So you get the Schedule E and then you put those numbers out to the marketplace. And the buyer makes an offer based on the Schedule E, based on the numbers you put out, but the offer is typically contingent upon seeing the seller's Schedule E within X days, and the buyer has X days to void the transaction in her absolute discretion. That's typically how it's done. I got a phone call from a lady from Springfield, Illinois. This is earlier this year, lady from Springfield, Illinois. And this lady's on my website. I have a 4-part series, a video series, and I do free coaching, anybody who buys that. Well, she was a customer of that. And she called me up and she said, hey, Tom, I want to tell you a story. I said, okay. And she was in Springfield, Illinois, which is the capital of Illinois. I think she was trying to buy a 10-unit apartment building. 10-unit apartment building. And the listing broker was marketing the property with gross operating income up here of $93,000 and some change, 93,000 something. And she said, Tom, I made an offer, written offer, and I did it just like you said. I made it contingent on seeing the seller's Schedule E within 3 days. And then she has 3 days to void the transaction in her absolute discretion. And she said, I presented the offer one morning to the listing broker in the listing broker's office. And the listing broker went ballistic. The listing broker said, what is this Schedule E thing? Hey, we don't do that Schedule E thing here in Springfield. And she said, well, I got to know the numbers are right. He said, well, I don't care. We don't do that. And I said to her, so what'd you do? She said, well, I folded up my briefcase. I went home. Well, that afternoon, the listing broker called her back and said, I've been doing some checking, and I guess it's reasonable that you would want to verify the numbers. And so they revived the offer. They negotiated. They got an accepted offer contingent on seeing the seller's Schedule E. Now, she made the offer based on the gross operating income being how much? 93,000 something something that the broker had said? Take a guess what the gross operating income really was. She got the Schedule E. What was the gross operating income? It wasn't 93,000 something something something. It was 38,000 something something something. Now you tell me, would that skew the numbers a little bit? If you were buying a money machine and expecting it to produce 93,000 and it produces $38,000, well, that's not going to work. And you'd put that number in the worksheet and you'd work the work, and the worksheet's going to go, come on, this isn't going to work. Don't be doing this. Pardon me. So we want to be as accurate as possible. Schedule E. The other thing is there's a little measurement that we use called an operating expense ratio. If you had this property listed for sale and you ran an ad in the newspaper, if there were still newspapers, and somebody called you up and said, hey, you know that apartment building you got, what's the operating expense ratio on that thing? All it is a little formula. Let's do it off to the side here. Your operating expense ratio is nothing more than the operating expenses. It's your OPEX, operating expenses, which in this case is 27,747, divided by the gross operating income of 61,110. If you do that math, that's about a 45% operating expense ratio. 45% operating expense ratio. What does that mean in words? 45% operating expense. What does that mean? All it means is of every dollar that Maggie would collect on this property, 45 cents of it is already spent just to operate the property. 45 cents of every dollar is already spent. That means she's got 55 cents of every dollar to do what? No, not to travel the world yet. She's got to pay her debt service. So she's got to pay her debt service and herself out of the 55 cents, right? So this is really important, isn't it? This operating expense ratio. And will there be an average operating expense ratio in your town on certain types of property? And that'll be different on a shopping center than it is on a rental house, that it is on an apartment building. The average operating expense ratio in this country, now that's a big place, but in this country, on a little apartment building like this would be somewhere around 45 to 50%. If we don't know the numbers on a property, we just routinely cut the income in half, and you won't be that far off. Do any of you manage property? Are any of you property managers? And what would the operating expense ratio be on an apartment building in your town in Nebraska? If you know that, chat that in. But it'll be somewhere around 45 to 50%. You won't be that far off. Now, in this case, 45% operating expense ratio sounds reasonable. Sounds reasonable. So that's a proceed with caution. What if you saw an operating expense ratio on a property that was 30%? 30%. Wouldn't that raise an alarm in your mind? And run the operating expense ratio on your MLS, investment properties for sale, and you'll get a sense of what's going on in your town. But if you saw 30% operating expense rate, what could cause that to be true? It could be the owner's not fixing anything. What if I said, Maggie, repairs? Are you kidding? This is such a great building. I haven't had to repair anything for 8 straight years. Well, what does that mean? The day after she buys it, the whole thing falls apart. But no. What could cause your operating expenses to be less than average? Legitimately. Could be a newer building. It's not. What are your 2 biggest expenses? Generally, what are your 2 biggest expenses in an apartment building? Property tax and utilities. Property tax and utilities are generally the 2 biggest expenses. Well, separate utilities will change this operating expense ratio. Separate utilities is a big deal today. And I think it'll be an even greater deal in the future. What are utility bills going to be in the next 10 years? Yeah, I don't know. But if you, the owner, are paying the utilities, are you at risk, not only in the real estate market, but also in the utilities market? Yeah. How cold does it get in your town in Nebraska? Cold, right? Cold. It's January. The wind is blowing. The snow is blowing. It's freezing outside. You get in your car. You start it up. You drive down the street. You drive past your apartment building and look at the upstairs window. What is it? Wide open. Why? The tenant's hot, man. And what's the furnace doing? Chug, chug, chug. On whose meter? Your meter. How many of you truly have seen a building with the windows open and the furnace running? How many of you have been in a building where there's a cage over the thermostat? I don't mean a plastic thing. I mean a metal mesh cage with a padlock on it. This is a major problem for building owners. I told you I used to teach this class at the University of Minnesota. I was speaking there one time, and we were in this great big auditorium, and the place was packed, and it had a balcony, and the balcony was packed. And I was down on the floor of the stage and I said, how many of you ever been in a building where there's a cage over the thermostat? And there was a kid in the front row of the balcony, right up there, right in the first row. And he raised his hand and I called on him and he stood up and he said, I know how to get around that. Well, not like I was asking for ideas from the audience. He told the class he lives in an 11-unit apartment building by the University of Minnesota, and the owner has one furnace in there. And the owner keeps it too cold in there. And the owner has a cage over the thermostat, a metal mesh cage with a padlock on it. The kid said, we can't even touch a thing. Can't even get a pencil down in there to move the thing. He said, every night when it's cold outside, what the tenants do is they get a great big bucket of ice water and a great big beach towel, and they dip the beach towel into the ice water and they hang that towel over the thermostat cage. And he said that furnace runs all night. And this kid was proud as can be of this. So separate utilities are big deals today, and that would affect your operating expense ratio. If you, the owner, are paying the operating expenses, are paying the utilities, I don't think you can run a little apartment building for less than 45%. I'd be real nervous. All right. So what are the three parts of the machine? Income, expenses, financing. Do we now know, for Maggie, do we know the income? Yeah. Do we know the expenses? Yeah. Do we know the financing? Yes. Yes. So we know the three parts of the machine. Let's turn the machine on. Let's turn it on. Flip the on switch, and it'll buzz away and produce what? Buzz, buzz, buzz. What's it producing? The first benefit is cash flow. Look at Roman numeral number 1 there. Cash flow. And not only is it the cash flow, it's how to figure the cash flow. So let's follow the worksheet. We start with the gross operating income. How much? Now be careful. Gross operating income, that's the 61,110. So fill this in with me now. 61,110. So that's what she collects after vacancy. But now what's she got to pay? Look what the worksheet, it'll tell you what to do. It says minus the operating expenses, which are 27,747. If you do that math, you get 33,363. 33,363. What is that 33,363? We call that her net operating income, NOI. Have you heard that term before, the NOI? Put a little star in the left margin by the net operating income. The net operating income is the center of the universe, and everything else is just kind of planets revolving around it. The net operating income is the amount of money that Maggie would have in her pocket at the end of the year if she bought the property. How? Cash. Cash. If Maggie came along and said $409,000, no problem. And she wrote a check for $409,000. Well, at the end of the year, she'd have 33,363 in her pocket, but she's not doing that in this case. She's saying 409,000, okay, but I'll give you 62,000 cash and finance this other 347,000 like this. So the next thing she has to pay out of that net operating income is her what? Is her debt service. See the word debt service? Debt service is just fancy university words for it's your monthly P&I times 12. See in parentheses, it's your monthly P&I, principal and interest, times 12, which in this case is what? See up at the top, the principal and interest is $2,450 a month times 12 is $29,400. So let's pay that. She's got to pay $29,400. So if you take your net operating income, you pay your debt service, she's left with $3,963. $3,963, and we call that $3,963 her cash flow before tax. And the market shortcuts it and calls it her cash flow. She's got $3,963 of cash flow. Is that good? What do you think? 3,963 cash flow, good? It's better than 3,863. It's not as good as 4,063. It's better than negative. It's better than negative. How many of you know people who buy a rental property and that number is a negative number? How many of you know people buy a rental property and they want that number to be a negative number? No, you don't. Put your hands down. Nobody knows anybody who wants that number to be negative. If that number was negative, what would it mean to Maggie? She'd be losing money. Whose money? Her money. What kind of money? Real money. Nobody wants to lose their own real money. If you want to lose your own real money, there's a lot easier ways than this. What people want is to make money, but tell the IRS they're losing money. And is that possible? Is it possible to make money, yet tell the IRS you're losing money? Is that legal? Yes, that's legal. What a country. Now you show this to Maggie, you say, Maggie, look at this. You ought to buy this property. What's she going to say? Real world, what's she going to say? Isn't she going to say something like, now you want me to invest $62,000 of my hard-earned money? worry about this thing all year, and I end up with $3,963. I could put the $62,000 in the bank and practically do that well, and I wouldn't have to worry about a thing. And you would say to her, what? You'd say, Maggie, that 3963 is only the first benefit. She says, I don't even want to hear the rest. You know, if you're starting with your good stuff, we might decide the deal's good or bad. We just have to decide it's good or bad based on all four benefits. Is she at any financial risk here? Is Maggie at any financial risk? None, zero. When is she doing this? Before she buys the property. She hasn't bought the property. She's just sitting at the kitchen table, noodling this out. She's just seeing if it's worth wasting the gas to drive by. Her biggest risk is she might fall off the kitchen chair. $3,963 cash flow. Can she spend that $3,963? Yes, on what? Anything she wants. Anything she wants. Instead of a $61,110 cruise around the world, could she end up with a $3,963 weekend in Omaha? Yeah, I'm not knocking Omaha. I like Omaha, but you could have a pretty good weekend for $3,963 in Omaha, couldn't you? $3,963. That's the first benefit. Now, would you believe me if I said these words? Or you should believe me, because this is true. And this is a really important concept when you talk the talk with your investor clients. These dollars right here, these dollars of cash flow, those dollars are twice as good as a dollar from your job. You remember we started out an hour ago saying all dollars are not created equal. Remember we had dollar from your job, dollar from your primary residence, dollar from your rental property. These dollars of cash flow from your rental property are treated completely different than a dollar from your job. What if I was the buyer and I said, you know, I'm not going to mess around with this real estate baloney. I'll just work overtime. I'll work some overtime and earn an extra $3,963 at my job. Same difference. Or I'm in the real estate business. I'll just earn an extra $3,963 commission instead of messing around with this investment stuff. Same difference. It's not the same difference, because if I earn that $3,963 from my job, what do I have to pay on that? I got to pay federal tax. I got to pay state tax. I've got to pay Social Security or self-employment tax. It cuts that in half. Dollars from your job are really 50-cent dollars. If I earn that $3,963 from a rental property, though, there's a whole separate tax rules, whole separate section of tax rules for rental property. If it comes from $3,963 comes from cash flow, we're going to see that it can be sheltered from income tax, state and federal, and it's exempt from Social Security or self-employment tax. People who make their living on their cash flow don't pay Social Security tax, don't pay self-employment tax. There's no self-employment tax. You could have $1 million of cash flow. There's no self-employment tax. And so the thing to burn into your mind is the dollars from a rental property are twice as good as dollars from a job. I would have to earn twice this. I would have to earn almost $8,000 at my job to equal $3,963 cash flow. And people say, oh, what a pain in the butt it is to own real estate. Well, it would have to be twice the pain in the butt having a job is, because the dollars are twice as good. First benefit for Maggie, $3,963 cash flow. All right. So we've talked about three parts of the machine: income, expenses, and financing. We've turned the machine on and it's going to produce four financial benefits: cash flow, principal reduction, tax savings, and appreciation. We've calculated the cash flow. What about the principal reduction, the tax savings, and the appreciation? You say, Tom, can you show me that? I say, sure, I can. You say, great, when? And I say, right after this 10-minute break. We're going to take a 10-minute break. Every hour we'll take a 10-minute break. Now, wait a minute. When I say 10 minutes, what do you think I mean? 10 minutes, 10 minutes. We're going to run this like a Swiss train station. So 10 minutes, get up, walk around a little bit. If you have questions, chat them in now. Chat them in. I'm glad to help. And let's take a break. 10 minutes.
Just real quick before you all break, Daniel, Catalina, can you please turn your camera on? And if your name's not correct, can you please write your full name in there? Please.
My camera's on my end.
Well, all I'm seeing is a black screen.
I mean, it's on and it's my camera light is on. I don't know. I guess what do I do? Because it says it's on.
Oh, well, you know what? I'm no computer guru. How about,
It's on mine. It says recording and my camera light on my computer is on. So I don't know.
I don't know. Okay, all right, well, you know what? I will just let it go for now. You
I'll see if I can get it.
maybe check your video. Ross says maybe check your video. I don't know what that means.
Yeah, I don't. See, now I click start video, it's off. Now it's back on.
Huh? Is it showing on your face, Daniel?
No, but on my computer, it says it's on.
Is there something covering your camera?
No, no.
This is one of the guys in the chat said some cameras have a privacy.
Before I logged on, it made me update to a new Zoom, and I updated it, and now it's on a new Zoom. But I don't know if that might have been it.
Yeah, I don't know. Okay, all right. Well, I guess we'll just have to let it go for now.
I mean, I could restart it, and when we come back on.
Let's just try to do, can you try to do something different over lunchtime, Daniel?
Yeah, I can try to restart it or something.
Okay, let's just try that. Let's just call it good for this morning.
Okay.
Okay.
2-minute warning now, everybody. 2 minutes, we'll go back to work. If you got any questions now, chat them in over the break or at any time, actually. Use the chat button. Roxanne, yeah, the 3963. Yeah, everything's annual. Everything's annual. That's your cash flow. So on the worksheet, we annualize everything. Another minute and we'll go to work. All right, let's go back to work, everybody. And I really am going to try to keep it, do my best to, when I say 10 minutes, mean 10 minutes. Don't you hate it when you go to some place and they don't really mean it when they're doing the time? And so I want you to use the chat button. Roxanne, does that make sense? The 3963. Let's just quickly review. You would do this worksheet when? Before you buy the property, before you list the property. This is a great listing tool. And if you've ever dealt with an unreasonable seller where the seller has a higher opinion of the property than the market does, don't get into an argument, work the numbers. What if the seller said, I got to have 600,000 for this thing? Well, run the numbers at 600,000. You'll see, well, it's going to be negative cash flow. It's going to be, who's going to buy that? And then it's not you against the seller. It's you and the seller against the numbers. There's only so many things you can do with a money machine that produces $61,110. Okay, so here we go. Here's Maggie. She's got the 3 parts of the machine: income, expenses, and financing. Then the first benefit, we take the cash flow and we start with the net operating income minus the operating expense gives us net operating income. The net operating income is the amount of money we'd have if you paid cash. That's what you'd have at the end of the year. But you're not paying cash in this case. We got to pay the debt service, which is $29,400. If you do that, Maggie would be left with $3,963. Can she spend that $3,963? Yes. On what? Anything she wants. It's her money. Is it taxable? Yes, it's taxable, but it can be sheltered by the depreciation, which we'll see as we work further down the worksheet. Really important. The last thing we said, the dollars from your rental property are twice as good as dollars from your job. And I think that's something that people don't think of. And this is what I would kid those young people. And when I was teaching the class at Minnesota, that if you go out and you're earning $39.63 from your job, that's not really $39.63. If you earn the $39.63 from a rental property, it really is $39.63, as we'll see here in a moment. So, all right, so $39.63, and you say to Maggie, you ought to buy this thing. She's going to say, come on, $62,000. I invest 60 and I end up with $3,900. I'm not doing that. I'll put my money in the bank. And you'd say, Maggie, that's only the first benefit. She says, I don't even want to hear the rest, if you're starting with your good stuff. Is she at any financial risk here? No. Why? She's doing this before she buys the property. Before she buys the property. Before she even drives by the property. So we got to keep going. Second benefit, principal reduction. What do we mean by principal reduction? Well, let's repeat the debt service. That debt service is, hang on, right there, $29,400. That debt service made up of two things. What? Principal and interest. If you take the time to amortize that loan, and amortize, remember, is a 3-syllable word. It's the second most mispronounced word in our business. What's the first? The first leads by a mile. Realtor. The word is not realtor, it's realtor. Now, we all know that in here, but how many of you know somebody who actually claims to be one, who pronounces it realtor? Or the double whammy, they say, I'm a realtor with XYZ realty. That's by far the most, next time you hear somebody in our business say they're a realtor, you look them right in the eye and tell them they ought to have their head examined by a doctor. Now, that's by far the most mispronounced. The second most mispronounced is amortize. It's not a motorized or amortize, it's amortize. Muerte, muerte. Anybody speak Spanish in here? Muerte, what's it mean? Death, to kill, amort. We're killing off the loan. When I played baseball in Venezuela, the fans used to yell, amort the umpire. When I played, used to yell, amort the umpire and the catcher. I was a catcher. Should I tell you about the time the umpire threw up on my neck? All right, maybe later. If you take the time to amortize this loan, you'll find that $24,123 of that is interest. $24,123 is interest. What that means is the difference, $52.77, is principal. All that means is after 1 year, Maggie wouldn't owe $347,000 anymore. She owes $347,000 less the $52.77. She owes $342,000 or whatever it is. And you think, come on, so what's the big deal? Well, it is a big deal. Who paid that for her? The tenants. The tenants paid her loan down $52.77. She just doesn't get the money till when? Till she what? Till she sells or maybe refinances, right? It's not a current benefit, but absolutely it's a benefit. If you don't think it's a benefit, take it to the extreme. What if that was a $347,000 30-year loan? And she kept the property for 30 years. What would she have at the end of 30 years besides an old building and really old tenants? An old paid-for building that who paid for? Those old tenants are saying, Maggie, we'd like to buy you this building. Are we going to say no? And yet most of us say what? 96 out of 100 of us say what? Oh, no. They might call me up. Call you up? They ought to be able to call you up once in a while. They're buying you a building, for heaven's sakes. $52.77. Now, you show this to Maggie. You say, Maggie, come on, you ought to buy this thing. What's she going to say? Real world, what's she going to say? I don't know. You want me to invest $62,000. I end up with $39.63. Then you tell me I get $52.77, but I don't even get that till I sell. I'm just going to put the money in the bank. And you would say, Maggie, that's only 2 out of the 4 benefits. We might decide the deal's lousy. We just have to decide it's good or bad based on all 4 benefits. Please don't judge it by any 1 or 2 benefits. We got to look at the whole package. Okay. Sarah, hi, good question. How did I get the $24,123 in interest? Well, I amortized the loan. Now, with a financial calculator, you can amortize the loan. Now, here's what some people think. You think, now, wait a minute, wait. If you take 7% of $347,000, you don't get $24,123. And that's true. That's correct. You don't. But you really can't do that. For how long am I borrowing $347,000? For how long is Maggie? It's Maggie buying the property. For how long is Maggie borrowing $347,000? 1 month. 1 month. As soon as she makes her first payment, she doesn't owe $347,000 anymore. So the interest the second month is different than the first month, and the third month is different than the second month, and so on. So that's what a good financial calculator, you'll amortize the loan. So if you amortize this loan, you'll find $24,123 just with a financial calculator. And a financial calculator these days, you can get a real good financial calculator for $25. And so I'd recommend to any of you who are really going to do this, to have a good financial calculator. So you can't really just, now it's not going to make that much difference, but to be technically correct, you can't just take 7% of 347,000. Okay. So 5277 is her principal reduction. 3963 is her cash flow. Now we got to keep going. Third benefit. It's 11:30 p.m. on the night of April 15th. And Maggie is thinking, I better do my taxes. Well, what's her taxable income on this property? What's her taxable income on this property? How much money does she have in her pocket from this property? 3963. What's her taxable income? 39. Whoa, what about this 5277, the principal reduction? Is that taxable? Taxable when? When she sells. No. That's wrong. Back your mental tape up 11 feet. Stop and start over. We got to tape over that last part because that's wrong. And you, professional realtor, need to know that's wrong. This principal reduction is not taxable when you sell. Has nothing to do with the tax you pay when you sell. When you sell your property, you pay tax on your what? You pay tax on your gain. Your gain. What does the average bear out there in the marketplace think they pay tax on when they sell? What do most people think they pay tax on? Either the sale price or, more commonly, I think, the money they walk out of the closing with. Could I sell my property and walk out of the closing with a check in my pocket for $100,000? And I think, oh man, I got to pay tax on $100,000. Do you know what? The IRS does not give a darn how much money you walk out of the closing with. That's a meaningless figure to them. That's your equity. There's no tax on equity. The tax is on gain, and gain and equity are how many different things? Two. Yes, you got it. Two. And they're two unrelated things. Could you have a large equity in a property and no gain? Yeah. Could the reverse be true? Could you have a large gain and no equity? Yeah. Gain and equity are two completely different things. The principal reduction and the cash flow, both of these numbers right here, are taxable every year. The principal reduction is not taxable when you sell. It's taxable every year. Does it make sense the 3963 cash flow should be taxable? Does that make sense? Sure, because what is that 3963 to Maggie? Well, that's profit from the tenants. We'll take that logic one step further. From whom did she get the 5277 that she used to pay down her loan? From the tenants. The IRS says if you're running a business and the money comes from your customers, it's taxable. Well, both of those numbers, the 3963 and the 5277, come from your tenants. Therefore, they are both taxable every year. That's the bad news, but there's always good news. There's always good news. The good news is, yes, they're taxable, but they can both be sheltered by the depreciation. You see, Congress, who writes the rules, and the IRS, who enforces the rules, they don't care. They pretty much don't care about anything we've done so far. What they care about is Roman numeral 3. Roman numeral 3 is how you figure the taxable income on any business in America. A little rental house, a big shopping center, a restaurant, your own real estate practice. It's nothing more than the net operating income minus the interest minus the depreciation. Whatever that works out to be, that's really what the IRS wants to hear about. You know what that is? Roman numeral 3 is really Schedule E with all the fat boiled out. Schedule E is actually, I think, 33 lines long. Here it is just trash compacted down to 4 lines. Net operating income minus the interest minus the depreciation, that equals your taxable income. Well, all right, that doesn't look so bad. Let's help her out. Here's our friend Maggie. Let's help her. Well, let's figure her taxable income. We take her, we start with the gross operating income, which is, we start with her net operating income. The net operating income, remember, is after the vacancy, after the expenses. We start with the net operating income, which is 33,363. Where did I get that number? I just took it from Roman numeral 1, 33,363. Then the next thing she had to pay out of that net operating income was her debt service. But is her entire debt service deductible for tax purposes? No, only the interest. How much interest did she pay? Look at Roman numeral 2, 24,123. Notice you can only deduct the interest. You cannot deduct the principal. You have to leave the principal in there. And that has the effect of making it taxable. So net operating income minus the interest, minus this third thing, this depreciation. And this is the part that goofs people up, and it shouldn't. We can make it real simple. The IRS wants Maggie or any of us to buy this property. She's going to provide housing for these wonderful people. She's going to fix up the neighborhood. She's going to invest her money. The seller's going to pay tax on the money. Whatever's left over, the seller's going to go out and buy stuff. And all those people pay tax on the money. So she creates a lot of tax by buying the property. They want her to buy the property. As incentive for her to buy the property, the IRS says, Maggie, if you buy this property, we will let you write it off as if it's going to zero value over time. We recognize it might be going up in value really, but we'll let you write it off as if it's going to zero value over time. And that process is called what? Depreciation. Depreciation. Technically, absolute technically, it's not called depreciation anymore. It's called what? Two words. I bet you've heard them. What's the technical term for depreciation? CR. Cost recovery. Cost recovery. Have you heard that term before? Cost recovery. Cost recovery, depreciation, same thing. Same thing. I'm going to use the word depreciation. Even the IRS used the word depreciation on their forms. But if a customer in the marketplace says to you, gee, what would my cost recovery be? And you go, man, I don't know. We didn't talk about that. No, cost recovery, depreciation, same thing. So Maggie, in order to figure her taxable income, she starts with a net operating income minus the interest, and now she gets to deduct her depreciation. But in order to deduct her depreciation, she has to know how much depreciation she qualifies for. So we need to talk about depreciation. All right. Now don't write anything down. Just you sit back and relax. Put your pencil down. I've got it because I've got this all written down for you. In order to depreciate the property, she needs to know what is she actually buying for $409,000, right? Her cost is $409,000. What would she actually be buying? What tangible physical assets is she be buying? Talk to me. She's buying what? She's buying land. Yeah, good. What else? She's buying building. Yeah, good. Don't leave me now. What else? What else is included in that? Personal property. What else? What else? Appliances would, yeah, that would be personal property. The appliances would be personal property. Yep. One more though, land improvements. You're buying four things when you buy a rental property, and you want to divide your cost into four things. Those four things. Now look back on your page 3. Back on your page 3 where you wrote the 3 parts of the machine and the 4 benefits. Do you see underneath the 4 benefits, it says depreciation rules? And I have it separated there, land, personal property, building, and land improvements. You want to divide your cost into those 4 categories. If you're not doing that, you are throwing away money. Now, most people, I would say a grand majority of people only divide it into land and building. That's really bad. That's really bad. It's legal, but it's bad. If all you've done is divide into land and building, you are throwing away money. You may as well drive home and at every stoplight, roll down your window, reach in your pocket and throw out a $10 bill. Then at the next light, roll down your window, throw out a $10 bill. You'll be amazed how many people follow you home. But see, nobody would ever do that. But that's what we do by not depreciating properly. Now, some people do land, building, and personal property. That's better. But you're still throwing out a $5 bill. You want to do all 4 of these. And I'll prove this to you. And if you're not doing this, you need to have a serious, I mean, really serious discussion with whomever is doing your taxes. Most people in America, this is the second biggest phone call I get from people who hear me on my video series on my website. They'll call up and they say, Tom, how come I didn't know this? I don't know, but here's how to fix it. All right, so in this case, Maggie needs to know how much of that $409,000 cost is land. How would you do that? How would you know how much is land? How did you do it? Those of you who own rental property, you probably divide into land and building. How'd you do it? You could call the assessor. If you were my client, you wouldn't go near the assessor. True or false? Your assessor has no clue the value of that property. How many of you have ever seen a property sell for a price different than its assessed value? You know what? In Nebraska, now you got to tell me because I don't know. In Nebraska, If you're trying to determine the value of a property, you don't waste your time doing one of those CMA deals, do you? Where you compare this house to other houses that have sold recently with a garage and a fireplace. Yeah, what a waste of time that is. Don't you just call the assessor? And you think, well, that's stupid. Well, I agree, it's stupid. If it's stupid there, it's stupid here. How would we do it? How do those of us who buy rental property, how do we do it? There's a word coming to you. Be open to it and let it come to you. And I can read your mind. I know exactly what you're all thinking. Bifurcate. Bifurcate. That's what you're all thinking. Now, you are probably sitting there wondering, how in the heck did he know that? What does bifurcate mean? It's not a bad word. You can say to mixed company, bifurcate, bifurcate. What does it mean? It just means divide. It just means divide. Look it up. It just means divide. If Maggie was buying this property and she got good tax advice, her good advisor would say, Maggie, you need to bifurcate. Now, a buyer can bifurcate anywhere, but where is the best place to bifurcate? On the purchase contract. Her good advisor would say, Maggie, you need to bifurcate right on that purchase contract. And what that means is when she makes this offer to me, $409,000, right in the agreement, she adds a little paragraph that says something like, it is agreed the purchase cost is allocated as follows. Land, this much. Building, this much. Personal property, this much. Land improvements, this much. Make it part of the deal if you can do it. Now, do you have to make it part of the deal? No. You want to make it part of the deal. But if it's going to mess up the financing, if it's going to mess up the deal, you can leave it silent as a buyer. But if you're ever audited and the auditor said, Maggie, where'd you get, let's say, $49,000 for land? What's your best answer? That's what I paid for it. That's the deal. It says right here. Let me ask you a question. Does the seller care how much is land, building, personal property, and land improvements? The answer is yes. Yes, the seller cares. Does the buyer care how much is land, building, personal property, and land improvements? Yes. Now, why does the buyer care? The buyer cares because each of these categories is depreciated over a different number of years. Why does the seller care? And the seller honestly cares even more than the buyer. The seller cares because each of these four categories is taxed differently. When you sell your rental property, you pay tax on your what? You pay tax on your gains, not gain, gains. There's an S on the end. You have a gain on the land, you have a gain on the personal, you have a gain on the building, and you have a gain on the land improvement, and they're each taxed differently. So I, as the seller, want to get as much of my gain on the thing that's taxed the least. The buyer, Maggie, wants to get as much of her cost on the thing that's depreciated the fastest. And the way that works out to be is we want opposite things. Will the IRS accept what we negotiate in the purchase contract? If it's reasonable, it can't be some goofy number. Yes. Why will they accept it? It was arrived at by two parties who wanted opposite things. The IRS position on this is, don't worry about us. We're going to get our money from whom? Not from both. They're going to get their money from the loser. And if you've never bifurcated, you are and you remain the loser. If you ever sold a rental property without bifurcating the agreement, you paid way more tax than you have to pay. And I'll prove that to you as we go along. So the buyer and the seller want opposite things. Okay. The buyer, why does the buyer care? Now we're looking at this from the buyer's eyes this morning. Why does Maggie, the buyer, care how much is land, building, personal property, and land improvement? They're each depreciated over a different number of years. I need you to know the number of years. So look on page 3, and you see I've got land, personal property, building, and land improvements. And then it says number of years. Let's put the number of years next to each one of these. The land, you depreciate the land over how many years? Yeah, 0. You can't depreciate the land. Put a big 0 there. The IRS says, Maggie, come on, the land's not wearing out. You can't depreciate the land. She says, okay. Then we move to personal property. Personal property would be things like stove, refrigerator, washer, dryer, drapes, curtains, carpeting, mailbox, garbage cans. Yes, he said carpeting. Carpeting is personal property, no question, from a depreciation standpoint. Now, I know what you learned in real estate school, that you can't go sell your house, and if you got wall-to-wall carpet, roll it up and put it on the moving van when you move. But from a depreciation standpoint, personal property would include carpeting, no question. So personal property would be the appliances. What else? How many years? Personal property, 5 years. 5 years. What if it's a really old refrigerator? How many years? 5 years. What if it's a brand new Frigidaire right out of the box? 5 years. What if I've already owned this property for years and years and years? I've owned this, I've depreciated all this junk down to nothing. Could Maggie buy it from me and start all over again? And you think, yes. And you think, well, how many times can the fridge wear out? Don't even think of it as wearing out. Think of it as, remember, what's the other words? Cost recovery. Cost recovery. Every buyer gets to recover her cost. Much of this property has been depreciated over and over and over again because every buyer gets to recover her costs. All right, so 0 on the land, 5 years on the personal property. Now the building, how many years on the building? The building, there's 2 possibilities, not 2 choices, 2 possibilities. It depends on whether it's a residential or a non-residential rental building. You see, I separated these for you. Residential rental building versus a non-residential rental building. The IRS distinguishes between those 2, and they have different depreciation rules. What's the definition of a residential rental building? Anything that people, what? Anything that people live in, live in for at least how long? For at least, no, now the 2 years, that's your primary residence. That's not what we're talking about here. To be a residential rental property, the tenancy has to be month to month or greater. Month to month or greater tenancy. So a rental house would be a residential, right? Because a rental house is month to month or year lease or something. The biggest apartment building in all of Nebraska would be a residential rental building because it's month to month or year lease or something. So month to month or greater. What about, do any of you own a furnished condo you rent by the week? That's a non-residential rental building. Non-residential has to be month to month or greater. In this case, this is a little apartment building for Maggie. So it'd be residential rental building, a residential rental building depreciated over 27 and a half years. 27 and a half years. So next to the residential, put 27 and a half years. Now, don't ask me where they got the 27 and a half. Nobody knows. Having the half on the end sure makes it sound scientific, like it came from somewhere. These are the rules. What if it's a really old building? How many years? 27 and a half. What if it's a brand new building? 27 and a half. Brick, 27 and a half. Has nothing to do with how old the building is or how old I am or how long your mortgage is. It's just, that's the rules, 27 and a half. Now that's for residential rental building. For a non-residential rental building, what's the definition of a non-residential rental building? Anything that's not a residential rental building. So shopping center, office building, home office, weekly rental condo, that's all non-residential. Non-residential, how many years? Anybody know? Non-residential would be 39 years. 39 years. Now, I said I don't know where they got the 27 and a half. I don't. I do, however, know where they got the 39. They added 11 and a half. And that's about how scientific the whole goofy thing is. Don't try to relate this to anything. This has nothing to do with how old the building is, nothing to do with how old you are, nothing to do with the mortgage, none of that. It's just, that's the rules. 27 and a half years for a residential rental building, 39 years for a non-residential rental building. Okay, well, Airbnb is Steve, that's a good question. If it's monthly, if it's monthly, then that would be residential, but a weekly rental Airbnb, that's a non-residential building. Now, to be a residential rental building, what does it have to be? Month to month or greater tenancy. So typically Airbnb would be less than that, right? So that would typically be a non-residential rental building. All right. And so I'll show you, Stacy, that's a good question. What if you switch? We'll do this. How about this? Here's what if I own a building that's a combination building? What if I own, let's say on Main Street, I own a nice little brick building on Main Street, and on the main floor, it's a bakery, and upstairs there's 4 apartments. What kind of building is that? It's actually both, isn't it? But it can't be both. For depreciation, it has to be one or the other. What do you want it to be? You want it to be residential because you can recover your costs faster. Well, to be a residential rental building, 80% of the income or more, 80% or more of the income has to come from the apartments. 80% or more has to come from the apartments to be a residential. So you could have a building where 75% of your income comes from the apartments and 25 comes from the bakery. That's a non-residential rental building. Another way to look at that, I used to own some property in Scottsdale, Arizona. We rent them by the month in the summer when it's 120 degrees, rent it by the month, and then during the season During the winter, we rent it by the week. What kind of building is that? I rent it part of the year for weekly and part of the year monthly. Well, what are the rules say? 80% or more of the income would have to come from the monthly summer rents. And it didn't. It wasn't even close. It wasn't even close. So if you had a house that you're renting month to month and then you switch it to Airbnb, you'd fall into that 80% rule in order to keep it as a residential renter building. So in this case, for our friend Maggie, this is a residential renter building, 27 and a half years. Now, put a little star next to land improvements. Those of you who work with investors or who are one, if you want some added credibility with your investor client, I want you to go to your investor client and I want you to ask them this question. I want you to say, how are you depreciating your land improvements? And I'll bet you $1 their answer is what? Huh? They won't even know what you're talking about. Those of you who own rental property yourself, go to your own accountant and say, how am I depreciating my land improvements? If your own accountant says, huh? It's time to make what we call an exchange. And I don't mean of properties, I mean of accountants. This is the second biggest phone call I get from people who hear me on. I told you I do free coaching. Anybody who buys the 4-part series on my website. And the second biggest phone call I get, it comes from from bifurcating. And they'll call up, I can see it a mile away. Here's what it sounds like. They'll call up and they'll say, hey, Tom, I've been investing in real estate for 25 years. I say, great. They say, but I never heard of land improvements till I heard you're on your series. I say, I can't help it. I didn't invent it. Here's what land improvements are. Land improvements are improvements to the land improvements to the property that don't service the building. Improvements to the property that don't service the building. And you think, what does that mean? Don't service the building. I don't know what that means. Can I tell you how to tell if something's a land improvement using people talk, not IRS talk? Yeah, here's how to tell if something's a land improvement using people talk. A land improvement is an improvement to the land that, if it could talk, would be able to say these words. I don't need no stinking building to do what I do. That's a land improvement. Now think about this. If you own a rental property, aren't there improvements to that property that, if they could talk, would be able to say, I don't need no stinking building to do what I do? Like what? All the landscaping, all the fence, all the pavement, driveway, sidewalk, parking lot, underground sprinkling system, swimming pool, tennis court, playground, golf course. Those are all land improvements. They don't need the building to do what they do. Those are all land improvements, and you get to depreciate them separately. Now, and you should depreciate them separately. Where do most people who have land improvements depreciate their land improvements? They put in with the building and they do it over 27 after 39 years. Or even worse, they put in with the land and they don't depreciate at all. Stop doing that, because land improvements are depreciable over how many years? Anybody know? Land improvements are depreciable over 15 years. 15 years, and we get accelerated depreciation, meaning you get more early and less later on. So you really, really, really can help somebody by telling them about land improvements. And you'll be shocked. You'll be shocked how few people depreciate their land improvements. And I mean experienced investors. I don't know why. I truly don't know why. And there are, most people just do land and building. And if you own a rental property and you go home tonight, or if you're home right now, don't do it now, but later on, after we're done today, take a look at your tax return and make sure, if you own a rental property, that your account is divided into land, building, personal property, and land improvements, because I'll bet you a nickel they haven't done it. And most people just do land and building, and that's just a terrible mistake. You're throwing away money. And I'll prove that to you as we go along, and I'll show you how to fix that. I'll show you how to see all that money that I can see from 800 miles away. I see lying on the floor in front of you. There's a big pile of money. Well, we're going to pick it up and put it in your pocket before we're done. All right, so land improvements, 15 years. So land, building, personal property, and land improvements. You want to do all 4 of those. Bifurcate. Bifurcate just means to divide. We're actually dividing into 4. So we are bifurcating into 4. Now, you're never going to forget land improvements and personal property if you use my worksheet. Let's go back to the worksheet now. Let's finish up the worksheet. And so do you see at the top here where I just drew a little box? This is where you actually calculate your depreciation. And look what it says. What's the land value, personal property, the building, and the land improvements? You cannot complete the worksheet without dealing with personal property and land improvements. You'd have a big hole in your worksheet if you didn't include personal property and land improvements. Now I'm going to show you how to actually calculate the depreciation in a little bit, but it's too much math for right now. Let me just give you the total. Remember, here's Maggie. She's doing this worksheet before she buys the property. You see where it says total appreciation? Let's say $18,500 for the year. And I'll show you where I got that number, but I just don't want to throw it in now. It's a lot of math. 18,500 for the first year depreciation. That's the depreciation on the personal property, the building, and the land improvement. Remember, on the land, she doesn't get any depreciation. So let's say she's got $18,500. She's calculated that in depreciation. Here's my question. So what? Big whoop. Where does it go? What good does that depreciation do for Maggie? Well, remember, we're down in Roman numeral 3. And look what it says. Roman numeral 3, net operating income minus the interest minus the depreciation. We now know the depreciation is 18,500. So put that there, 18,500. And now, if you do the math, let's figure it out. Roman numeral 3, net operating income 33,363 minus the interest 24,123 minus the depreciation 18,500. If you do that math, you end up with a taxable income. How much? You end up with a taxable income negative 9260. Negative, those brackets mean negative. Negative 9260. Everybody see that? Everybody agree with that? Her taxable income is a negative 9260. What if you showed this to Maggie? You say, Maggie, look at this. Your taxable income's negative 9260. What's she going to say if she's like most people out in the marketplace when you say, hey, your taxable income's negative 9260? Most people say what to that? Most people say, that's it, pal. If you mean I lose another 9260 on this turkey, I'm out of here. And you would say to her, what? How much money is she losing? Nothing. As a matter of fact, what does she have in her pocket? She's got $39.63 cash flow. The tenants paid her loan down $52.77. She's ahead. What is that? She's ahead over $9,000. Really? But when the IRS says, hey, Maggie, how'd you do on this property? What does she say? Oh, man, are you kidding? I lost $9,260. Well, the IRS says, Maggie, if you lost $9,260, you can now take that loss outside the building and use it over here against your income from your job. And it'll shelter $9,260 of her income from her job. And it'll shelter which $9,260 of her income from her job? It'll shelter the last $9,260. Why is that important? Because the last dollars you earn is your most expensive dollars. Remember how the tax brackets go? They're like stair steps. The more money you earn, the greater percent is taken, right? The last dollar you earn is your most expensive dollar. Well, this shelters $9,260 of her income, and it shelters which $9,260? Bottom up or top down? Top down. It shelters her last $9,260. She does not have to pay tax on the last $9,260 she earned. Now, this is subject to something called the passive loss rules. The passive loss rules. Now, we're going to talk about the passive loss rules in these next 2 days, but the passive loss rules govern when you can use that loss. When, not if, when. Most people will be able to use that $9,260 loss right now this year to shelter their income. Some people will have to carry it forward to use it in the future, but regardless, they're going to be able to use it. We'll talk about that in great detail as we go. So in this case, let's say Maggie can use that $9,260 to shelter her income from her job. Is she going to save or pay tax? Do you see where it says tax paid or saved? She's going to what? She's going to save. Circle tax is saved. Whenever you're telling the IRS you're losing money, circle tax is saved. She's going to save tax. Will this save her state income tax as well as federal income tax? Yeah. Could she easily be in a 30% tax bracket, right? State and federal. Most of you are in a 35% tax bracket. Let's say 30%. 30% of $9,260 is $2,778 income tax saved. Owning that property saves Maggie $2,778 in income tax. Will everybody save $2,778? No, some people will save more than that if they're in a higher tax bracket. Some people will save less than that if they're in a lower tax bracket. Everybody will show a taxable income of negative 9260. It's just going to save everybody a different amount of tax depending on their personal tax bracket. $2,778 income tax saved. Is that cash? That $2,778, is that cash money? That's cash, isn't it? That's cash, right? Because if she does not buy this property, what happens to that $2,778? If she doesn't buy the property, then she has to pay that $2,778. She has to pay it to the IRS, and the IRS wants it in what? Cash. That's cash. That's her third benefit here, folks. Third benefit is cash, tax savings. So look at this. She's got 3963 cash flow. She's got 5277 principal reduction. She's got 2778 income tax saved. All right, so let's keep going. The fourth benefit is appreciation. Appreciation. What do you think we ought to use for appreciation? I've got a number in mind. Let's use a percentage. Let's use a percentage. What do you think we ought to use? What do you use for appreciation? Well, yeah, you know, I'm seeing 2% and 10% and 5%. Yeah. I don't know, but the number I've got in mind is 0. And it's my webinar. So guess what? Put 0. I think the appreciation, when you estimate the appreciation, it ought to be 0. I'm not saying I want the appreciation to be 0. I want the appreciation to be as much as possible. But when you're analyzing the property, I would suggest the property ought to make sense. The money machine ought to make sense with no appreciation. I'm not saying I want no appreciation, but it ought to make sense with no appreciation. The appreciation ought to be frosting on the cake. And I hope the frosting is thick, thick, thick. But the cake ought to taste good by itself, you see? And if you're buying rental property where none of these numbers make any sense, none of these first 3 numbers now up here make any sense, but you're buying it because it's going to go up in value. If the reason you're buying it is the sole reason you're buying is that it's going up in value, do not deceive yourself into believing you're a real estate investor. You are a real estate speculator. Now, there's nothing wrong with that, but recognize the difference. Is there a difference between speculating in real estate and investing in the housing market? And the answer is yes. A speculator doesn't do any of this. A speculator just buys a property and hopes it's going to go up in value, and maybe that'll work out. And see, depending on how long you've been in the real estate business, I've been in the real estate business 45 years. It goes up, it goes down, it goes sideways. Speculators have done well if they get out in time. Investors have done well all the way along because they're buying a money machine that makes sense starting day one. How many of you know somebody who buys a rental property that has negative cash flow? They buy a money machine that loses money, but they buy it anyway because they think it's going to go up in value. Well, maybe it will, but I think, I got to be honest with you, I think that's dumb. I just think that's dumb. If you're buying a money machine that loses money, the only way you're going to make money is in the future to find somebody dumber than you. You got to find somebody dumber than you who has money. I would hate for my portfolio to be based on me being able to find somebody in the future dumber than me. I can't find anybody dumber than me who has money. Now, I'm kidding you a little bit, but I'm doing it on purpose to make the point. The property ought to make sense, in my opinion, with no appreciation. I'm not saying I want no appreciation. I'm saying it ought to make sense with no appreciation. The appreciation is frosting on the cake. So down, look at the bottom. There's some various rates of return. Various rates of return. Here's our return on investment with appreciation. Then the second one is return on investment without appreciation. Let's do it without any appreciation. So it's asking us to add up the first 3 benefits. We add up the cash flow, plus the principal reduction, plus the 2778 income tax, right? So I'm just adding up that right-hand column. If you add that up, that's $12,018. $12,018 would be, what would Maggie be investing at $12,018? She's investing what, $62,000. So divide the 12,018 by her $62,000 investment, and you get 19% in your money. That's 19% on her money. 19% on her money before what? Before any what? Before any appreciation. 19%. Is that good? Is that bad? I don't know, good or bad. Good or bad compared to what? You know, you're sitting there thinking, hey, 19% sounds pretty good compared to money in the bank. Well, yeah, but you cannot compare real estate to money in the bank. You've got to compare real estate to what? Other real estate. Other real estate. Right now, chances are you do not know what's a good or bad investment in your town. That's not a pejorative statement. I just mean you don't know because you haven't done the numbers. Do the worksheet on several properties in your town, real properties, and you'll know what's good or what's a bad rate of return in your town. 19% in this case. That's before any appreciation. The appreciation would be frosting on this cake. The worksheet helps, yes. The worksheet helps. And you would do this worksheet when? Before you buy the property. Before you buy the property, before you list the property. If you have a rental property, if you're listing a rental property, you should do this worksheet and see if it makes any sense. If the seller says, I got to have 600,000 for this, don't argue with the seller, run the numbers at 600,000. And the worksheet will tell you, well, this thing isn't worth 600,000, it's not going to work. And then show that to the seller. How many of you can see a use for this worksheet? Tell me if you can see a use for this. Just say yes. If you can see a use for this. How many of you can think of a real human being who would be interested in this? Yeah, a real human being. If you know what, if you knew just this basic worksheet right here, if you knew how to explain this and you lived in Medford, Oregon, you would have a client who's going to buy $2 million worth of real estate over the next year. And he can't find anybody who understands this. There's no hard math, is there? There's no hard math. No hard math. A lot of numbers, but there's no hard math. The worksheet tells you what to do. Plus, minus, equals. Would you believe me if I said there's lots of people in the real estate business who cannot do what you just did right here? Would you believe me if there's lots of people, if I said there's lots of people on this webinar who cannot do what you just did right here? No, you can do it. I'm kidding you. You can do it. You can do it. No hard math. You would do this worksheet before you buy the property, before you list the property. Make sense? Now, what if you showed me this and I said, you know, this is pretty cool. I never understood this before. You know, I'm thinking about buying this property. I'm thinking about buying a property like this. But you know what? I'm a pretty conservative guy. And if I had a $347,000 loan on my property, ooh, man, I'd lie awake at night staring at the ceiling, wondering how in the world am I going to pay it if something goes wrong? So here's what I'm thinking. I'm thinking of buying this property, but I'm thinking of paying cash. Are there people who pay cash for their rental property? Yeah. Yeah. What if I said, can you show me my rate of return if I pay cash? What would you say? You say, sir, I can. I'd say, great. When? You'd say, what? Not right now. You'd say, right after this 10-minute break. Take a break, 10 minutes. 10 minutes. Chat in your questions now. If you're at all foggy on this, chat in, because the train is just pulling out of the station, man. We're gonna go deep, deep, deep. All right, take a break. If you're not sure where a number comes from, let me know. Stacy, if I'm understanding your question, if you've owned it for 30 years, it's already depreciated. There's nothing left to depreciate. Right? If you're depreciating over 27 and a half, you've depreciated that building all the way down to nothing. So there's no cost remaining to recover when you switch to the Airbnb.
Gotcha. So in the event, like say you owned it for 20 years and there was 10 years of depreciation left, then
Then,
you would do it based off the 39
correct.
mark
Correct.
until
in
it's
it-
completely depreciated.
Yeah.
Okay. Thank you.
Yep. 2-minute warning, everybody. 2 minutes, we'll go back to work. All right, let's go back to work, everybody. That's 10 minutes. You doing okay? Stacy, yes, we're going to cover depreciation recapture. We'll cover that in a big way this afternoon. We'll do that. What else? What questions now? Is everybody okay? Could you explain it back to somebody? The trick is, not trick, but you should practice explaining this. Any of you who want to be really good at this, you got to practice explaining it to anybody who listened to you, your husband, your wife, your mom, your dad. Practice explaining it into a tape recorder and play it back. It'll make you sick. In your mind, you think you sound like Einstein. You play it back, you sound like Daffy Duck. But the more you do it, the better you'll get at it. And you'll see that there are certain places where certain questions almost always occur, and you can deal with those questions. So that's good. Steve, yeah, I'm with you. But you're just a kid, Steve. You got 30 more years to go. What else? Could you explain it back to somebody? Practice, just practice. So here's our friend Maggie. She's got cash flow 3963. Can she spend that? Yes. Anything she wants. Is it taxable? Yes, but it can be sheltered. We find that out in Roman numeral 3. She's got principal reduction 5277. She doesn't get that till she sells or maybe refinances. When's it taxed? Every year. What's the logic behind that? It came from her tenants. If it comes from your tenants, it's taxable. All right. But so the cash flow and the principal reduction are both taxable, but the good news is they can both be sheltered by the depreciation. And that's what we find out in Roman numeral 3. So there's enough depreciation to shelter her income and end up with 9260 left over. She shows a loss of 9260. She really doesn't lose the money. She just gets to tell the IRS she lost the money. What created that loss? Depreciation, which is what kind of expense? Non-cash. It's just accounting. It's not real money. Tax deductions are good. Yes. Non-cash deductions are great because we get to deduct them. We just don't have to pay them. And then we'll talk about what happens when you sell the recapture. Okay. So she saved 2778. We added up all the benefits, divided by the 62,000. We got 19% on her money. And you would do this on several properties in your town and know what's good and what's bad in your town. So that's great. That's terrific. Now, what if I said to you, I'm your client now, and I say, I'm thinking of buying the property, but if I had a $347,000 loan, I'd worry about it. I'd lie awake at night worrying. So I am going to buy this property. What I'm thinking about doing is buying this property, but I want to pay cash. Are there people who pay cash for their property? Yes. And shouldn't we be able to help them? And the answer is Yes. And so here's what I want you to do. Turn in your book, or no, tear out another worksheet. Tear out from the back a plain investment property worksheet. You have many of these worksheets there, and we'll use them. The other thing is, I want to say, if you like the worksheets that we use, if you want really clean, crisp copies of them, go to my website and click on the baseball bat that I'm holding, and that'll take you to a side page, and you can print out the worksheets from there. But for now, you've got plenty of them for our 2-day GRI. All right, so this is cash. I'm thinking about paying cash, and I say to you, the realtor, can you figure my rate of return if I pay cash? You would say what? You'd say, sure, I can. Now, is my return going to be higher or lower? If I pay cash, I don't have any of that nasty old interest expense. Higher or lower? Well, yeah, we got it narrowed down. I hear a little of both. A little of both. Well, my website is just tomlundstead.com. Alicia, it says on the front of your on the front there, and see it's down at the bottom of all the pages. It's tomlundstead.com. All right, so cash. Here's what I want you to do. I'm your client. I'm thinking about paying cash. I want you to take the worksheet and calculate my rate of return if I pay cash. All right, I'm going to give you plenty of time. You work on your own. Now round off to the nearest dollar. All right, no pennies, no pennies. And tell me my rate of return if I pay cash, and then tell me what you would advise me to do. And then you got to prove it to me. All right, so take your time, sharpen your pencil, let your calculator do the numbers. Chat in if you have questions, chat them in, and do me a favor so I know kind of how fast you're working. Chat in your answers. When you get the cash flow, chat it into me. When you get the print reduction, chat it into me, so I can just kind of keep track of the pace. All right, I'm going to be quiet, and here's your assignment. Here's your question. What is my rate of return? What are my 4 benefits and my rate of return if I pay cash for the same property we've just analyzed? Okay. All right, you can do it. I know you can do it. And then think how you would, yes, same expenses. It's this property, not the previous one. It's this property. So we've done one property all day, Sarah. So yes, the income and the expenses would be the same, wouldn't they? But now we don't have any financing because the income and expenses are the same. Okay, go ahead and do it. Go ahead. Let me know if I can help. I'm gonna turn off the video, and I'll mute so I'm not bothering you. I know you can do it. I've got confidence in you. Chat in your answers. And my real question is, what would you advise me to do? I'm your client. I'm thinking of buying this property. You got this property listed. I'm thinking of buying it, but paying cash. All right, go ahead. When in doubt, follow the worksheet. The worksheet will tell you what to do. This minus this. The first time through, it'll be a little rocky because you're not used to it. We're going to do lots of these over the next 2 days. When the income and the expenses are the same. So I filled that in on the upper half. So chat in your answers now as you go. Chat in each of the Roman numerals. Please do that. That helps me. Otherwise, I'm lonely here in Wisconsin. Roz, double check Roman numeral 3. I'm not quite sure what that is. You're looking good, everybody. Are you saving or paying tax? Be careful when you get down there now. Take your time. If you finish before everybody else, that's okay. Just bask in your glory. But I want your advice, and I want you to explain it to me with dollars. Take your time. Think how you would explain it to a client. Roz, do you see Roman numeral 3? Double check your Roman numeral 3, Roz. Steve, you're good on the first two. Roman numeral 1, good. Roman numeral 2, good. Roman numeral 3, no. Some. And now, are we paying or saving tax? We got to pay tax now, right? Pay. So Steve, double check your Roman numeral 3 and your rate of return. Roz, that's it. And just again, you don't put any pennies into it. Just round to the nearest dollar. Kathy, hang on now. What about your print? You're forgetting the cash flow and the principal reduction, Kathy. That's just the tax paid divided by, that's tax paid, right? So Kathy, I think you've got all the numbers, but the summary is not right. The return on investment. Yep, there you go. Matt, first one's good. Second one, no, zero principal reduction, right? There's no principal reduction. Alicia, double check. Are you saving or paying tax, everybody? You're paying tax now, right? You got to pay tax. Pay tax. The IRS is going to reach in your pocket. Sarah, double check your cash flow. If you pay tax, that your 3963, that's if you have financed it. No, we're paying cash. That's it, Kurt. That's it. Well done. So what would you advise me to do? I've got 409,000. I came into your office. I want to invest it in real estate. Stacy, assume there are a bunch of these properties for sale. It's a whole row of them down the street, exactly the same. Just for fun. Let's say 30% tax bracket, so which is what we used prior. That's it, Steve. That's it. Well done. So again, what would you advise me to do? Or what might you suggest? Or what alternative might you give me? Right? Does everybody see you're paying tax now? You're paying tax. Yeah, but Matt, give me some numbers. I'm not disagreeing with you, Matt, but just see if you can give me some numbers. I've got $409,000 in my pocket to invest. And there are a bunch of properties like this for sale. That's it, Alicia. That's it. Well done. Matt, that's it. Yeah, Jen, now how much? Yes, if I did what you're saying, Jen, tell me how much money I'd have. At the end of the year, how much money would I have? That's it, Kathy. Well done. Stacy's same with you, second Jen, but tell me, give me dollars. How much money would I have at the end of the year doing it your way versus paying cash? Take a couple more minutes, then we'll go through it. Yeah, or you might look at the, Jen, you might look at the total bottom line. If I've got 6 of them versus 1 of them. Again, there's no right or wrong answer. It's just to present the options and let the client decide. Alicia, it's a right idea. You're a little enthusiastic on the 6 of them though. If I buy 6, remember I'm finding, so look at the first worksheet we did and multiply by 6. But you got the right idea. Let's try it. Let's try it together. Now, do you agree with me? There are people who pay cash for their real estate. Sure. Well, shouldn't we be able to help them? Sure. All right. Well, if I pay cash, what does that do to my income, my expenses? Nothing. Nothing. The income and the expenses are exactly the same, right? As the first one we did. But remember, there's 3 parts to the machine: income, expenses, and financing. Well, we changed the financing. We changed the financing to 0. So purchase cost is 409. The cash invested is 409. All right. So the income is still 61,110. Operating expenses still 27,747. That doesn't change. So let's figure the cash flow. We take the gross operating income, which is 61,110, minus the operating expenses, 27,747, gives us net operating income, 33,363. Now you stop me if you're not sure where a number comes from. So the net operating income, 33,363. That's the same number we got before, the other way, exactly the same. None of that changes. All right, minus the debt service, which in this case would be 0, right? We don't have any debt to service, so 0. So now I've got 33,363 in cash flow, which is way better than that cruddy 39,63 I got the other way. And you'd say, hang on, big boy. All right, so the first benefit, 33,363. The second benefit is principal reduction, where there's no principal to reduce. So put 0, so that's easy. Then what do we tell the IRS? Well, same formula. You take the net operating income, 33,363, minus the interest, which is 0. There's no mortgage, minus the depreciation, $18,500. No, wait. You mean to tell me the depreciation is the same whether you get a mortgage or pay cash? Yes. The depreciation doesn't care about your financing. It's called cost recovery, not loan recovery. All right, so now look at this. Look at Roman numeral 3. If you make the calculation, net operating income minus the interest minus the depreciation, you end up with a taxable income, 14,863. That's a what 14,863? That's a positive 14,863. Whereas before, remember the other way, we were getting a negative 9,260. Now we're getting a positive 14,863. What does that mean? The IRS says, okay, you are now making money, so we are now taking money. Circle tax is paid. You got to pay tax now, man. In a 30% tax bracket, state and federal, you got to pay $44.59. The IRS is going to reach in your pocket and take away $44.59. The appreciation is 0. And now let's add it up down to the bottom. We add up the cash flow, 33,363 plus 0 principal. And the tax savings is a negative 44.59. The IRS is going to take it away from you. So you're left with 28,904. What would I be investing to get 28,904? 409,000. I paid cash. If you do that math, that's 7.1% on your money. 7.1. Look at this. Same property, same tenant, same income, same expenses. You do it the first way, you got, what do we get? 19%. You do it this way, you get 7. What is your professional responsibility to at least point out to me here? What would you say, hey, Tom, if you want to pay cash, we'll write it up, we'll pay cash and you'll earn your 7.1%. But Tom, if you really do have $409,000 to invest, you ought to at least consider buying 6 of these. Now, is this just a trick to get me to buy more real estate? It's just a trick you realtors do. You'd say realtor. I say, I don't care what you call it. It's just a trick. Don't know. Do I have enough money? If I've got 409,000, do I have enough money to buy 6 of them with 62,000 cash invested? Yes. And now what if I said, you're killing me? You're killing me. I want to pay cash because I need this 28,904. I need that 28,904 down here. I need that money. What would you say? Wouldn't you say, hey, Tom, instead of 28,904, would you consider 72,000? And I say, get out. Look at this. Do I have enough money to buy 6 of them? I do. If I bought 6 of them, look at this. They produce 12,018. I'd have 6 times 12,000. That's $72,000. 72,000 versus the 28,000. Plus, if there is any appreciation, I'd have the appreciation on what? 6 rather than 1. What's the right answer? There is no right answer. There is no right answer. Our job is to present the options. Do you agree most people in our business don't present any options? Show me this. I might just decide, hey, I don't care what you say, I'm paying cash. Well, fine. I'm not saying don't do it, but I'm saying if you're paying cash, open your eyes, be sure you're doing it with your eyes open, realizing you're earning 7% when you could be earning 19. That's all. Might the person say, okay, I'm not buying 6 of these. Are you crazy? But I see what you're saying. I'll buy 2 of them, or I'll buy 3 of them. Everybody will play it differently in their mind, but you, the professional realtor, you're helping people build and manage their wealth. Show them this. Let them decide. What if I said you're killing me? You're flat out killing me. I just told you that I want to pay cash because if I had a $347,000 loan on my property, I'd lie awake at night staring at the ceiling, wondering how in the world am I ever going to pay it if something goes wrong? And your solution is to get 6 of them. You'd say, that's right. You got to decide what's more important, money or sleep. I'll tell you what would keep some people awake is knowing they were earning 7% on their money when they could be earning 14 or 19. That would keep me awake all night. Think about this. We're doing all this before we buy the property. We've looked at one property this morning, and we've looked at it different ways. Here, think of this. Can you picture a child's block, a wooden block, the alphabet block, ABC block? So on one side of the wooden block is A, and then you turn around and then there's B and then C and turn the block around. Well, analyzing a property like this is a little like a block, a child's block. On the one side, we bought it with 62,000 cash invested and borrowed the money, and we got 19%. Ooh, then we turned the block over and now we paid cash and we got 7%. Yeah. All right. Well, let's turn the block again. Isn't there yet another way we could buy this property? Let me just show you something. Let me show you the power of the business you're in. How many of you know people who have 62,000 equity in their home? Could I go down and borrow 62,000 against the equity in my home? Yeah, assume I qualify. Yeah. Now the problem with borrowing money is you got to what? You got to pay it back. Not only you have to pay it back, you got to pay it back plus what? Yeah, interest. Interest at what rate today? Second mortgage. I don't want one of those fakey adjustable rate loans. I want a real loan. What rate? I don't know, 6, 5, 7, let's say 10. Let's say 10 to make it easy. If it's less than 10, it's better than I'm going to show you. 10% of that is $6,200. What is that $6,200? It's interest. $6,200 in interest. What is interest? What really, how would you explain interest? What if I just landed on this planet? And I said to you, what is this interest thing you earthlings have? What would you say? It's just rent. It's just rent. If you don't have a house, you rent an apartment. If you don't have a car, you rent a car. If you don't have money, what can you do? Rent money. You march right down to First National, rent a center, and you say, hey, I'd like to rent $62,000 your dollars. They say, okay, but the rent is $6,200. You say, okay. And they say, here, sign the lease. That's what you're doing when you're borrowing money. Now, does the IRS want me to rent this money? Maybe. The answer is maybe. Now it says on the screen, look at this, $6,200 deductible interest. Here's my question to you. As we stand here or sit here in 2022, would the interest on that home equity loan be deductible? The answer is it depends. It depends. I guarantee you, those of you who would talk with someone about this is going to say, all right, no. The interest on home equity debt is no longer deductible. It's no longer deductible. And that's true. You cannot deduct the interest on home equity debt. But when somebody says that to you, I want you to say, what about the IRS tracing rules, tracing rules. What the tracing rules say is the deductibility of the interest depends on what you do with the $62,000. See, if I borrow that $62,000, I use to go on vacation or buy some personal thing or buy a car, it's not deductible. But what if I use that $62,000 to buy a rental property? And you could trace the use of that $62,000 directly to the rental property. The way you would do that is you'd borrow this $62,000, put it in a separate account and use it to buy the rental property, or you could have a line of credit and write a check against your house directly to buy the rental property. The tracing rules, if the IRS can trace the use of that $62,000 to the rental property, then it's not home equity debt anymore, it's rental property debt and would be deductible. All right, in a 30% tax bracket, it would save me $1,860. So the real cost of borrowing that money is $4,340. You with me? $4,340. All right, now what am I going to do with that $62,000? I'm borrowing it and I'm going to use it to buy that little apartment building like Maggie. And that apartment building gave me $39.63 cash flow. It gave me principal reduction of $52.77. This is just what we figured out, remember, on the first worksheet. And it saved me $27.78 in tax. No appreciation. The total was $12,018. That money machine gave me $12,018. All right, now wait a minute. Could this be possible? I rented the money and it cost me $43.40. I used the money to buy a money machine that gave me $12,018. What did borrowing the money and buying the money machine actually cost me? Nothing. Didn't cost me anything. I'm ahead $76.78. It didn't cost me anything. What's my rate of return? Remember, we're looking at a child's block. It's the same problem. We've done one property all morning. The first way we did it was $62,000 of our own money, cash invested. We got 19%. Or we paid cash on the other side of the block and we got, what was it, 7.1%. Now turn the block this way. And what's our rate of return if we do it this way? It's the infinite rate of return. It's the infinite rate of return. I'm earning 76.78. I didn't invest anything. Plus you all told me I could borrow the money at less than 10%. If I can borrow the money at less than 10%, it's infinity. Look at the power of this, kids. Look at this. Will the average guy do this? No. Why? They're the average guy. The average guy is home watching people eat worms on TV. The average guy looks at this and says, don't listen to this guy. Where'd this guy come from? We're not doing this. This is too risky, too risky. Well, fine. I'm not saying do this. I'm just saying, look at the block from all sides and you decide what's the right answer. It's up to you. It's up to the client to decide. Our job is to present the options. How many of you wish you would have done this 15 years ago? All right, well, the next 15 years aren't going to be any different. Don't come up to me 15 years from now at GRI and say, oh, Tom, I wish I would have done what you talked about back there in 2022, because what am I going to say to you? Shut up. Will the average guy do this? No, why not? They're the average guy. The average guy. We haven't even talked about appreciation, haven't even put in there. How many of you can think of a real property in your town that you think will be worth more 15 years from now than it is today? Well, all right. How many of you plan on being alive in 15 years? Okay, if you plan on being alive anyway, come on, take a look. I'm kidding with you a little bit, but I'm really not. Underneath, I'm serious as can be. We've done one property, and if you can explain this to clients, this will absolutely, you'll attract clients like you've never attracted clients in your life. I promise you. How many of you know somebody in the real estate business 20 years has really no idea how this stuff works? There's no hard math, is there? There's no hard math. There's a lot of numbers. I realize there's a lot of numbers, but there's no hard math. Make sense? Make sense? I hope so. I hope so. All right. Here's what I want to do. I think we better pick up the money that's lying on the floor in front of you. So that's what I want to do. Before lunch, I want to pick up the money that's lying in front of you. Tell me about depreciation. Just tell me about depreciation. If you have no questions for me, I've got some to make you think a little bit. We want to divide our cost into what, and what. We want to divide into land, building, personal property, and land improvements, because each of those is depreciated over a different number of years, right? You with me? All right, so you don't have to write anything. Just look at the screen now. Look at your screen. I've got the top half of one of my worksheets. We're done with that $409,000 property. So this is a generic property. I want to show you how this works. Let's say you're buying a property that has $20,000 of personal property in it. How would you know it has 20,000? You put in the purchase agreement. If you don't put in the purchase agreement, then you'd have to make an itemized list. You know, if it's a fourplex, I got 4 stoves, 4 refrigerators, I got this many square feet of carpet, I got curtains, drapes, refrigerators, you know, all this stuff. You depreciate that over 5 years, but you know you can't, that would be too simple. The IRS gives us a percentage, a table of percentages that we must use. And if you go back to page 3, I'll do all the math for you right now. You go back to page 3 and you see underneath where you wrote the depreciation number of years, I've got example and I've got year 1 and year 2. The IRS gives us percentages we have to use. And so look at personal property, year 1, and it says 20%. So on my worksheet, the way you would calculate the depreciation, 20,000 personal property times 20% would be $4,000. Bang, zoom, that's it. That's your depreciation first year on the personal property. All right, then the building, or let's do land improvements. Let's say I've got $30,000 of land improvements. What are land improvements? Improvements to the land that don't need no stinking building to do what they do. You depreciate them over 15 years, but you cannot divide by 15. You have to use their percentages. You get 5% the first year. Who says? IRS. 5% of 30,000 is $1,500. All right. The building, let's say we've got a $150,000 building. What do we need to know about the building before we can depreciate it? Is it residential or non-residential? All right, that's residential. I get 3.48% the first year, which is $5,220. And you add that up, there's $10,720 in depreciation. It's that simple. All right, now look at the second year. I've got 2 years here for you, and there's nothing magic in 2 years, but I just want to show you that it changes each year. On the personal property, the second year, I get 32%. So I get 20% the first year. The second year, I get 32% of the original 20. You always use the original amount. You don't have to subtract the previous depreciation and all this baloney like we used to have to do. So the first year, I'd get 20% of, in this case, 20,000. The second year, I get 32% of 20,000, and so on and so on and so on. Now, I'm just showing you the first couple of years because there's so many numbers. If you want the whole chart for all the years, for all the different properties, again, go to my website, click on the baseball bat, and that'll take you to a chart that has all the years. On the building, you get 3.48% the first year, 3.64% the second year of the 150 in this case. And on the land improvements, you get 5% the first year and 9.5% the second year, always of, in this case, $30,000. Does that make sense? No hard math, just a lot of numbers. So the question is, okay, if I were you, I'd be sitting there saying, okay, so what? What's the big deal? Here's the ta-da to this. Turn in your book to page 4. Page 4, and look at case study number 1. Case study number 1 on page 4. You with me? Remember, this is set up in 4 separate sections. So we're doing, the first section is the buyer. Case study number 1. Let me read this with you. You're in the process of purchasing a small apartment building. Underline apartment building. Why is that important? Is it residential or non-residential? It's residential. Remember, what's residential? Anything that people live in for what? Longer, month to month or greater. Month to month or greater. All right, your accountant has advised you buy it for $500,000. Your accountant has advised you to use the assessor's land building ratio of 20% for land, 80% for building. That's how the vast majority of America, including you, is depreciating. What if I buy this $500,000 property? I go to my typical accountant and I say, can I depreciate that? Yeah. How do you do it? You divide it into land and building. How do you do that? You use the assessor's ratio. So you look at the property tax statement, and the assessor is saying, in this case, the land is 20%. 20% of 500,000 would be 100,000 for land. The building is 400,000. That's how the vast majority of America is doing it. That's how probably you are doing it. Paragraph 2, calculate your depreciation for the first 2 years, assume a January purchase. Now I'll do the math with you here. On the land, we get how much depreciation year 1 and year 2? Nothing. Nothing. So that's easy. The building, we get how much the first year? What percent? On your page 3, remember the percent is 3.48%. Who says? The IRS says. It's not my number. 3.48% of 400,000 is 13,920. The second year, we get 3.64% of 400,000. 14,560 is $28,480 in total depreciation the first 2 years. I'm just showing you 2 years as an example. We could use 3 years, we could use 5. I just want to make the point here. So if I buy this property, I get $28,480 in depreciation the first year, the first 2 years, $28,480. Every dollar of depreciation will shelter a dollar of my income. That's $28,480. I do not have to pay tax on. If I would have had to pay tax, and in this case, we're using a 35% tax bracket, 35% tax bracket, I would save 35% of that, which is $9,968 income tax saved. Owning this property saves me $9,968 income tax. Is that cash money? Yep, that's cash money. If I do not buy this property, what happens to the $9,968? I got to pay it to the IRS. So I save $9,968. I think this is fantastic. My accountant's a genius. Let's keep reading, shall we? Paragraph 3. Before the closing, you attend a seminar taught by some guy who talked about bifurcating. He really got your attention when he showed you how to depreciate personal property and land improvements. Recalculate the depreciation on your small apartment building by assuming the personal property and the land improvements are each 10% of your $500,000 cost. How much extra depreciation does this method provide? How much extra tax do you save? How long will it take you to get a new accountant? All right, look at this now. Let's still use 20% in this case for the land. Let's still use the assessor's ratio, 20%. And now I'm not saying it's always 20%, but in this case, let's say. So how much land do we have? And you think, well, $100,000. Nope, you just swung and missed. You just threw away $7,000. And here's why. Your assessor's land building ratio is exactly that. It's a land building ratio. It's not a land building personal property and land improvement ratio. So before you apply the assessor's land building ratio, get the personal property and the land improvement out of there because they have nothing to do with the assessor's land building ratio. So in this case, look what it says. The personal property is 10% of 500,000, which is $50,000. All right, so let's do that, 50,000. And the land improvements are 50,000. Get those out of there. That leaves 400,000 as the remaining cost. The 400,000 is the what and the what. That's the land and the building. So the land is now 20%, not of 500,000, 20% of 400,000, which is 80,000, and the building is 320. All right, here's what I would like you to do. I would like you to please see what you can take the percentages from page 3 and calculate for me how much depreciation I would get in year 1 and in year 2. Give me the total and multiply by my 35% tax bracket and tell me how much tax savings I have as a bifurcating specialist. I'm going to turn you into a bifurcating specialist. Okay. And so I want to know year 1, how many things are we depreciating? We're depreciating personal property, land improvements. The land is still 0 and the building. Go ahead and do it. If everybody gets the right answer, we're going to quit at noon and take a lunch break. If anybody misses, anybody, I mean 1 person or more, we're still going to take a lunch break. So there's no pressure, no pressure, no pressure. So my real question is, how much extra tax do I save as a result of being a bifurcating specialist? All right, go ahead and do it. You can do it. I'll be quiet. So use the percentages on page 3 and lay it out like I've got it laid out on the screen like this. Okay, go ahead. You can do it. I've got confidence. You got 3 things to depreciate. The land is still 0. If you get the right answer, I will designate you a bifurcating specialist, and you can write this on your business card after your name. You can put that after your name, which some of you may, maybe it's already there. All right, I'll be quiet. I gave you the personal property here. See if you can do the math for the rest. My real question is, how much extra tax do I save? Chat in your answer when you get an answer.
Tom, if you're talking, you're on mute.
Oh, I just gave a great explanation explanation on mute. It was really good. Trust me. It was really, really, really good. All right. So you do it the way your account did it, you save 99.68, just land and building. But you know better than that. You know that it's personal property, land improvements, land and building. If you do all the math, you get $56,034 in depreciation. Wait, look at this, twice as much. In a 35% tax bracket, 35% of that is 19,612. So the difference, you do it the way your account did it, you save 99.68. You do it the way you, a bifurcating specialists, are going to do it, you save 19,612. The difference is $9,644. How many of you agree with me? That's just in 2 years. How many of you agree with me that $9,644 is a lot of money? How many of you know people who argue at a closing over a $45 refrigerator and there's $9,600 lying on the floor? Show them how to bend over and pick it up. Which of these is legal? They're both legal. Do you think if you're doing it this first way up here, the IRS is going to call you up and say, you know, I think you could do a little better? No, no, this is your money. Those of you who own rental property, you talk with your tax manager and say, come on, are we bifurcating? Are we doing this into land building, personal property and land improvements, or are we just doing it in land and building? Now, here's the question that everybody asks. They say, okay, all right, you got me. I've owned this property. I've owned my property a long time and I've done land and building. Now I realize I could and should have been doing land building, personal property and land improvement. Can I switch? And the answer is no. You cannot start out land and building, do that for a few years, and then go, oh, from now on, land building, personal property and land improvement. You have to go back to the beginning and start over. Now, if you were this person, it would be easy. All you would do is go back and amend your tax return for year 1 and year 2. You amend your tax return for year 1 and year 2, and the IRS will send you a check for $9,644. The problem is you can only amend a tax return how far back? 3 years back. So if you realize this within the first 3 years, you just file amended tax return. But the bigger question is, what if you bought the property when? What if you bought the property 5 years ago or 8 years ago? Then what? You can't amend a tax return that far back. And so people think, all right, I bought the property 5 years ago. I'm what the IRS calls dead meat. But I want you to repeat after me. I am not dead meat. I am not dead meat. And here's why. You are not dead meat because you know this, and I want you to write it in big letters. Form 3115. Form 3115 is an IRS form, and it's called a request for new accounting method. Well, actually, here, I'll put one up. 121, right there. Here. It's application for change in accounting method. Here's the front of a 3115. It's really a couple pages. One of the sections in Form 3115 is depreciation. And on 3115, it'll say, all right, you ask your good accountant now. You do this with your accountant for sure. You ask your accountant, have they ever filed a Form 3115? If they don't know what you're talking about, then they don't know. Okay. Now, the IRS, the Form 3115 will say, all right, how have you done your depreciation up till now? And you say land and building. Then you say, well, how are you really allowed to do it? And you say, I can do land building, personal property and land improvement. I'd like to change. I'd like to switch my accounting method to land building, personal property and land improvement. And I've taken this much depreciation with land and building, but I could have taken this much depreciation, land building, personal property and land improvement. I'd like to switch. And the IRS says, okay, you can switch, and any depreciation you've lost up till now, you can make it up all in 1 year. Here it is right now. Here, take it all, get yourself up to right now, and then going forward, your land building, personal property and land improvement. So Form 3115 is a way for you to correct, if you've just been doing land and building, to do land building, personal property and land improvement. And Mike will talk about tax deferral versus tax savings. talk about that. That's a good point. All right. So for this year, we saved this much tax. Whether we pay it in the future, pay it back, we'll talk about that. That depends. Again, if you're a bifurcating specialist, remember I said as a seller, you want to have this in the agreement? Okay. All right. So Form 30, you know what? I got a phone call from a guy not too long ago from Cleveland, Ohio. He called me up and he said, hey, Tom, you don't know me. I said, well, it's one of 300 million other Americans I don't know. What do you want? He said, I'm calling to thank you for something. I said, oh, okay. And he said, I listened to your video series. He said, I filed Form 3115 and the IRS just sent me a check for $19,200. 19,000. And he said, I'm calling to thank you for the 19,200. I said, don't thank me. Don't thank me. I didn't do anything. It was your money. It was lying on the floor in front of you the whole time. All my video did was show you how to bend over and pick it up. Any of you who own rental property, you ought to have a serious discussion with your accountant and be sure that you are a what? A bifurcating specialist. All right, let's have lunch. It's 12 o'clock. How about a little after 12? How about an honest 1:15? 1:15, and we'll tear it apart. And then this afternoon, we're going to talk about selling. So this morning, we talked about buying. This afternoon, selling. So 1:15, an honest 1:15, we'll crank it up. Be sure to print out the study guide for the second section. Remember that if you printed the whole thing, look at the second section and kind of isolate that from the other part. That's what we'll be doing. If you have questions, chat them in to me. Otherwise, get up and walk around, go for a walk this afternoon, go for a walk over lunch, and I'll see you at 1:15. Daniel, I just saw your question. Yeah, land is zero. You cannot depreciate land. It's not the land value is zero. It's the depreciation on the land is zero. Right? You can't depreciate the land. Christy, you doing okay? We doing okay?
I'm doing good, kiddo. I'm gonna take my medicine.
All right. Go
If
get
you
a
hear
big.
any weird groaning, grunting, you might want to call my kids. No, it's good. It's good.
Okay.
So, I'm good.
Wait.
You're good. There we go.
Wait. You cut out. What did you just say before you laughed?
I said, I'm good. You're good. If I pass out, you might want to call my kids. So,
Oh, all right. I've got your cell phone. So
yeah.
well,
Tell them I'm laying on the floor.
we're all set. You feeling okay?
Yeah, no, I'm feeling good. We'll see what the
Okay.
next treatment is. So,
All right. Put your feet up on the desk and just enjoy.
okay, I will do
All right.
that.
All right. See you in a bit.
Bye, Dom.
a month. Now, wait a minute. Wait. What?
I started recording again, Tom. I'm sorry. I
Oh.
should've done it
Oh,
before
that's
we
right.
started, and I
That's
forgot.
right. I didn't catch what, I thought somebody was talking to me. All right, so here's the blank worksheet. And so the top part, let's fill it in. 610,000, 175,000. We're going to get a $435,000 loan at 5%, $2,400 a month. Now, wait a minute. Wait. What if you had this property listed for sale? And I called you up and I said, all right, that little apartment building, what's the price? What would you say? What's the price on this thing? You know what? It's not $610,000. It doesn't say purchase price. It says purchase cost. And so when somebody asks you the price of your listing, here's what I want you to say. I don't know and I don't care. All right, try it. What's the price? No, I don't care. You don't know and you don't care. On the worksheet, it doesn't, nowhere does it say price. Now, what's the down payment? I don't know and I don't care. You don't know and you don't care, because you see on here, it says purchase cost is 610. The cash invested is 175. People ask me sometimes, okay, where on the worksheet are the closing costs? They're in there as they should be. It doesn't say purchase price, it says purchase cost. So that 610 is the price plus the closing costs. They're part of your cost and they should be in there. The cash invested doesn't say down payment, it says cash invested. That cash invested, the 175 would be your down payment and your closing cost, your out-of-pocket closing costs. Okay, so the closing costs are in there. $435,000, 5%, $2,400 a month. And there's your annual rent, your vacancy, your operating expenses. Let's say you're in a 30% tax bracket, state and federal. There's your depreciation. Now, you know how to do the depreciation. I'm just trying to save some time here for, you would know how to do the percentages just like we did before lunch, but I'm giving you the total, 25,300. There's your first year interest. Circle that 21,586. I'll always give you the interest in here in GRI. And some of you have a calculator that'll amortize the loan, and some of you don't have a calculator that'll amortize the loan. Some of you have a calculator that'll amortize the loan and you're not sure how to use it to amortize the loan. Now, no matter where you fall on that spectrum, I'll always give you the interest. And you bought it in January. So here's what I would like you to do. See if you can take that information and complete the worksheet for me. Give me my cash flow, my principal reduction, tax savings, let's say zero appreciation, and what's my rate of return if I buy this property, and chat in your answers as you go, just like you've been doing. That's great, because then I can tell how you're doing. You with me? I'm going to get, by tomorrow afternoon, you'll be able to practically do this worksheet in your head, because this is the foundation. This is the backbone of your real estate sales and investment. If you could do this worksheet, you'll knock people's socks off, and you'll get more referrals than you can stand. Yeah, Alicia, what we did this morning. No, they're in no, not what we did this morning. Page 4, case study number 1. Page 4 of the second section. All right, go ahead and do it, everybody. Go ahead and do it. I'll be quiet. Take your time. I'd rather have you slow and correct than fast and wrong. And round off to the nearest dollar. Don't put any pennies in there. Okay, I'm going to turn off the video. All right, go ahead and do it. You can do it. I know you can do it. All the information is found in case study number 1. Page 4, case study number 1, 610,000. The operating expenses are given in there, Sarah. When in doubt, follow the worksheet. And as you work, think how you would explain this to people. because it's one thing to get the numbers. You all can get the numbers, but how to explain it. Okay, and please chat in your answers as you go. When you get cash flow, chat it in. When you get your principal, chat it in your tax savings. If you can do this, you really know your stuff. That's it, April. Well done. Chat in your answers, please. What are you getting for cash flow, everybody? What are you getting? As you get your cash flow, let me know. Yeah, Mike, that's it. That's your cash flow. Matt, double check that number's something else, I think. For the tax savings, that's a little aggressive. That's it, Jane. That's your cash flow. April, that's your cash flow. Eric, good, very good. Alicia, double check that number now. That's too much cash flow. Sarah, good. Sarah, again, good. That's it, Mike, for your principal reduction. And then roll it all up, Mike. What's my rate of return? Eric, that's it, good. See, and again, think how you would explain this to people. Pretend like you have a client sitting in front of you and you're walking somebody through, because you'll get people all excited about this. Mike, the first part's right. The second part's not right. It's not, the second part, it's not that bad, that low. Alicia, do it like the case study says now. We're doing it financed. You got up at the top, you got 175,000 cash invested. Stacy, I don't know what that number is. What is that? Or your cash on cash. Stacy, that's your cash on cash. Sarah, the interest is given in the problem now, the case study. Remember you circled that. The interest is given in the problem, everybody. I'll always give you the interest. So it's in the case study. Yep, Stacy, cash on cash, fine. Now, we haven't talked about cash on cash. We will. Matt, tax savings, not that much. I'm giving you the depreciation now, everybody. Yeah, Stacy, that's the right, that's the cash on cash. We've not talked about cash on cash. Give me the overall rate of return if you can. Eric, that's good. Tax savings, good. What's my overall rate of return? Add up my benefits and divide by my 175,000 cash invested. April, do you have the case study open? Look at the case study and it says what the interest is right there. That's it, Sarah. Mike, good. Mike, did you get, if you pay cash? The interest, look at, Mike, I don't know where you're getting the 19,254 if you pay cash. I'm stumped on the 19,254. Eric, that's it. Don't say 175,000 down, say 175,000 cash invested. Remember, it's the down payment and the closing costs. April, what is that number? That's your principal reduction. The interest is given in the problem. You see, it's 21,586. It says first year interest. Kurt, I'm not quite sure what that number is. Is that your overall rate of return on your 175,000? Is that what you're thinking? Mike, did you get it figured out for cash? There you go, Steve. That's it. Brenda, that's it. Good. Well done. Now, if you finish before everybody else, try it as if you paid cash. Do it as if you paid cash. Just take another worksheet and pay cash. And then tell me what you would advise me to do. Again, pretend like you have a client in front of you and you're talking with your client. That's fun to do it that way, or fun to think of it that way. Mike, you're getting closer, but don't forget you got to pay tax. That would be your cap rate, but I don't think you mean cap rate. If you're looking for your overall rate of return, you got your cash flow, which is that number, and then pay the tax. That's it, Eric. So Eric, what would you advise me to do? And prove it to me. Tell me how much money I'd have. My way versus your way. That's it, Kurt. Well done. April, that's it. That's your tax paid, April, right? Or tax saved, I mean, tax saved, 2591. Yeah, that's perfect. And let's say zero appreciation, no appreciation. Yeah, and we haven't talked about cap rate and cash on cash, so don't worry about those yet, everybody. We'll talk about those in a big way. But Brenda, that you're correct, but we haven't talked about that yet. Try it as if you paid cash now also. As you finish, just take another worksheet and do it as if you paid cash. What's my rate of return if I pay cash? There you go, Mike. That's it. Your taxable income is not not that number, but that's your overall benefits is the 34,365 divided by your 610, 5.6. Good. April, that's it. Good. Now try it as if you paid cash. And once you do it for cash, tell me what you would advise me to do. I've got $610,000. I'm sitting in front of your desk. You're on floor duty. I come walking in with a suitcase. I open it up and say, I got $610,000 to invest in real estate. Can you help me? Tell me what you'd say. Well, compared to what, Mike? That's it, Roz. Well done, Roz. Now try it for cash. Sarah, that's really close, but somehow it's just a little tiny bit. A little tiny, I'm getting 5.6. That's it, Jane. Well done, Jane. Now do it for cash. Yeah, Steve, that's perfect. So what would you advise me to do? Here I am in front of you with a suitcase full of 610,000. I want to invest it in real estate. Okay, Sarah, so that's all right. So redo it. Well, I'm looking for your advice. I'll pay you for your advice. I've got enough to purchase how many of these? You've got a bunch of these listed. You've got 10 of these identical properties listed. What should I do? All right, Stacy, tell me how much money I'd have if I did what you're saying versus buying one with cash. At the end of the first year, I've got how much in benefits if I pay cash versus your suggestion of buying three. Yeah, I'd have three versus the, if I buy two, if I buy one with cash, what do I have? 34,000. Yeah, plus I'd have the appreciation on three rather than one. Again, there's no right answer. I'm not saying here's what everybody ought to do. I'm just saying here are the choices. Let them choose. Yeah, yeah, Eric, now you're talking. So if let's say you got a bunch of these identical properties for sale, I've got enough to buy 3, right? And have 85,000 left over. Yeah, good, well done. So I might say, Eric, forget it, I'm paying cash. I'm buying 1. What would you say? You'd say, okay, let's write it up. But what you did is show me the possibilities. Yep, there you go. There you go, Steve. Give it a try for cash now, everybody. It's not that low, April. It's better than that. That's it, Kurt. If you're paying cash in this case, you have to pay tax, right? You've got positive taxable income. April, I don't know what that number is. Take a couple more minutes, then we'll do it together. April, what is that number? The 7590? Brenda, is that if you pay cash? I think what you might have done is done tax saved rather than tax paid. You got to pay tax, take away the tax. Right? If you paid cash, you'd have positive taxable income. The IRS would say, all right, we're taking some of that money. So I think you got everything right, except the IRS is knocking on your door. That's it, April. Brenda, I think you did the same thing. You're not saving tax if you're paying cash in this case. You got to pay it. Let's try it together. Let's try it. Now, you're all cooking. This is great. I'm glad you're chatting in. You're doing great. Don't let the numbers get you. You know, stand back from the numbers. And Brenda, we'll go through it together now. We'll go through it. And could this be absolutely possible? Sure. You've got investors who pay cash, and you got to be able to help them. You got to compare the different ways to buy the property. So the actual question in the case study is, I'm going to buy this property with a cost of $610,000, and I've got to invest $175,000 cash. I'm going to get a $435,000 loan, 5%, $2,400 a month, and that times 12, the 20 for the debt service would be $28,800. All right, so just follow along as we walk through. And even though you got the numbers, let me show you maybe how to explain some of these things. We got annual rent of $78,700, but we're going to take 10% of that away. And I'm not saying you should always use 10%. You should use whatever is appropriate in your market. And so the vacancy rates are going to change depending on the type of property. There's not a vacancy rate in a town. There's a vacancy rate on different types of property. How many of you are in a market where it's really hard to find a rental house right now? What if I was traded, or not traded, what do they call it? Transferred, same difference. If I was transferred to your town and I saw you and I said, you know, I'm not really familiar with the town. I'd like to rent a house for a year and then I'll think about buying. Would it be easy or hard to find a rental house? Hard, isn't it? In lots of places, Those of you who own a rental house, if you make it known that you've got a house for rent, you get lots and lots of inquiries. I think that's true in most markets, actually. All right, and now, but on a different type of property, there might be a high vacancy. So you just got to study the market. In this case, we're taking away 10%. We're left with $70,830. And we call that your gross operating income, GOI, gross operating income. Out of that, though, we've got to pay our operating expenses. And the operating expenses are everything besides your debt service, everything besides your mortgage payment. In this case, $32,581, and that's given in the problem. All right, so we know the income, the expenses, and the financing. Remember, those are the three parts of the money machine. Let's turn the machine on and figure the four benefits. So the first benefit would be cash flow. We take the $70,830 minus the operating expenses, $32,581, gives us $38,249 in net operating income. What's the definition of net operating income? It's the amount of money I'd have in my pocket at the end of the year if I bought the property. How? Cash. If I came along and paid $610,000 cash, at the end of the year, I'd have $38,249 in my pocket, but I'm not doing that. I'm saying $610,000, okay, but I'll invest $175,000 and borrow the other $435,000. So the next thing I have to pay is my debt service. What does debt service mean? It's just fancy words for principal and interest. Well, my debt service is $2,400 a month times 12 is $28,800. So I've got the net operating income. I pay the $28,800. I'm left with $9,449, $9,449, and we call that $9,449 my cash flow before tax. And the market shortcuts that a little bit and calls it cash flow. We've got $9,449 of cash flow. Can I spend that cash flow? Yes. On what? Anything I want. It's my money. Is it taxable? Yes. But it can be sheltered by the depreciation. We don't know if it is or not till we get down to Roman numeral 3. So is cash flow taxable? Yes, but it can be what? Sheltered by the depreciation. $9,449. That's cash money. All right. Second benefit, principal reduction. We take the debt service. That's the $28,800. And then we amortize the loan, and you could do that with your financial calculator, but I'll always give you the interest in the GRI here. The first year interest is $21,586. And so the difference then must be principal, which is $72,14. To figure the interest, why can you not just take 5% of the $435,000 loan? Because the $435,000 loan only exists for 1 month. as soon as you make a payment, you don't owe 435 anymore. You might owe 434,990, but the interest is different the second month, then the third month, then the fourth month, and so on. That's what your good financial calculator will do for you. All right, so 7214 is my principal reduction. So not only do I have 9449 cash flow, the tenants pay my loan down 7214. I don't get that 7214 till when? Till I sell or maybe refinance, right? It's not a current benefit, but absolutely it's a benefit. Does my net worth go up 7214? Yes, because my liabilities were paid down by the tenants. All right, now what do we tell the IRS? Roman numeral 3. Well, the IRS wants to know what's your taxable income. And so we just follow the formula. Take the net operating income. We just repeat that from part 1, which is 38,249. Then minus the interest. You can only deduct the interest. You cannot deduct the principal. That's 21,586. Minus the depreciation. That's given in the case study, 25,000. Here we go through. We did all this. So that's cool. In this case, I did all the math up here. You know how to do this. We did the example before lunch, but $25,300 would be your total depreciation. 25,300, assuming you're a bifurcating specialist, which all of you are. So what good is that 25,300? That goes down into Roman numeral 3. And so now to figure the taxable income, we take the net operating income minus the interest, minus the depreciation. You end up with a taxable income negative 8,637, negative 8,637. Everybody see that? Everybody agree with that? You'd say, hey, Tom, your taxable income's negative 8,637. What if I said, I'm not in this to lose money? I'll tell you that right now. You'd say what to me? You'd say, good, good. You're not losing any money. As a matter of fact, what do I have in my pocket? I've got 9449 cash flow in my pocket, 9449. The tenants pay my loan down 7214. I'm ahead. What's that? I'm ahead $16,600, really. But when the IRS says, hey, Tom, how'd you do on this property? What do I say? I say, oh man, I lost 8,637. I really made 16,000. I just get to tell them I lost 8,637. What created that 8,637 negative? Depreciation. Depreciation created that loss. That's a non-cash deduction, 8637. Depreciation creates that loss. What if I said to you, what if I was your client and I said this? What if I said, okay, all right, now wait a minute. I thought you told me that I get 25,300 in depreciation. If I get 25,300 in depreciation, I ought to be able to use the whole 25,300, not just this lousy 8,637. What would you say? You'd say, Tom, you are using the whole 25,300. And I say, what are you talking about? Here, now think about this. Here, just this will unburden some of the fog, maybe. And this is a real good way to explain it to people. If you buy this property, if I buy this property, the IRS says, hey, Tom, here's $25,300 in depreciation right here. Here's $25,300 in depreciation. Every dollar of depreciation will shelter a dollar of my income. So that's $25,300 of income I can earn without having to pay tax on it this year. Now, does the IRS care what income we shelter? They do. You first have to shelter any income from this property. So this is a good way to think about it. I think of the $25,300 depreciation. It's a depreciation rabbit. It's a little rabbit. So look, here's your property, and out in the backyard there's a rabbit hole, and a $25,300 rabbit pops up out of the ground and looks around to see if there's anything to eat. Well, the depreciation rabbit looks around and, oh, look over there. There's $9,449 of cash flow. So the rabbit runs over and gobbles up $9,449. So now there's still $16,000 roughly rabbit looking around saying, is there anything else to gobble up on this property? Well, is there? Yeah, there's 7214 in principal reduction. So the rabbit runs over and gobbles up the 7214. And now how much depreciation is left? How much of the depreciation rabbit is left? If you do the math, it's 8,637. 8637, and that's your loss. That's what you report to the IRS. This will always work. This loss is your leftover depreciation after you take the depreciation and shelter cash flow and principal reduction. You've got 8637 left over. So you are using the whole 25,300. You're just first using it to shelter the income and the principal reduction from the property. Then anything left over shows a loss, and that loss is reported to the IRS as a negative 8637, which you can now take outside the property. The rabbit, the depreciation rabbit, the 8,637 depreciation rabbit looks around and says, okay, my work is done here, and it can go outside the property and shelter income from your job. If I'm in a 30% tax bracket, 30% of that would be $2,591 in income tax saved. Am I using the whole 25,300? Yep. It's first used to shelter the cash flow and to shelter the principal reduction, and any left over will show a loss, and that can go outside the property to shelter other income. All right, so now that's the third benefit. The fourth benefit is appreciation. Let's say nothing. If we add up the cash flow plus the principal plus the tax saved, that's 19,254. You divide that by the 175 you're invested, and that's about 11% in your money. That's 11% in your money before any appreciation. Is that good? Is that bad? Well, I don't know, good or bad. You think, hey, it's good compared to money in the bank, but you cannot compare real estate to money in the bank. You got to compare real estate to other real estate. So you'd have to do the worksheet on several properties and see whether it's good or bad. If you can do what we just did here, you'll knock their socks off. You know more than 90% of people with a real estate license about real estate investing. And we're just getting started. We're just getting started. Okay, makes sense. And then we did it for cash. We said, what would be the return? What I'm going to pay cash. You say, all right, if you pay cash, what does that do? I'm investing 610,000 anymore now. I don't have a mortgage anymore, but my income and my expenses are still the same, right? So now let's figure the cash flow. We take the gross operating income, 70,830 minus the expenses, 32,581 gives us 38,249. That's the same net operating income as before. That doesn't change. Minus the debt service, which is zero. I don't have any debt to service, so 38,249 is my cash flow. I'd say I've got 38,249 cash flow now, which is way better than that cruddy 94,49 you just showed me the other way. And you would say what to me? Hang on, big boy. The first benefit, 38,249. Second benefit is principal reduction, zero. We don't have any loan. What do we tell the IRS? Same formula. You take the net operating income minus the interest, which is zero, minus the depreciation, 25,300. Right? The depreciation is the same whether you pay mortgage, get a mortgage or pay cash. If you make that calculation, you end up with 12,949. 12,000. That's a what? 12,949. That's a positive 12,949. Right? Whereas before we were getting a negative 8637. Now it's a positive 12,949. What does that mean? What if you were the rabbit? If you're the $25,300 rabbit and you pop up out of the ground and you look around and think, is there anything to eat here? You go, yeah, it's a banquet. There's 38,000 cash flow over there. So the 25,000 rabbit runs over and gobbles up part of the cash flow, but what's left over is 12,949. You don't have enough depreciation to shelter the cash flow. So the IRS says, okay, you've used all the depreciation here at the property and you got 12,949 taxable income left over. So you got to pay tax now. Circle tax is paid in a 30% tax bracket. 30% of that is $3,885 paid. Fourth benefit is appreciation. We'll say nothing. You add up the cash flow, you add up the principal reduction, and then you take away the tax. The tax savings is a negative number. You take that away, you're left with 34,364. What did you invest to get that? 610. That's 5.6% on your money. That's my 5. We'll talk about passive income. We want it not to be taxed as passive income, Eric. We'll talk about that in a big way. Not yet though. 5.6%. The passive. Eric's asking about passive income, and he's exactly right. The passive rules govern when you can use the loss. You're always going to be able to use the loss. The question is when. For most people, they can use it right now this year. And we'll talk about the exceptions to that. All right, so 5.6% if I pay cash. So what would you say to me? If I truly do have $610,000 to invest, don't I have enough cash to at least think about buying 3 of these, right? 3 of these with 175,000 cash invested. If I buy 3 of them, I'd have 3 times 19,000, that's $58,000 plus the appreciation on 3. If I put all 610 into the one property, what was it? Then I've got 34,000 instead of 58,000 plus the appreciation on 1. What's the right answer? There is no right answer. Our job is to present the options. And if you can present these options, you won't believe what'll happen. I mean, you really won't. If you can get really good at explaining this with passion and enthusiasm, there will be people who will seek you out. How many of you right now know people who have money who don't know what to do with the money? And you think, well, nice problem, but it is a problem for people. And where are they going to invest their money? That, you know, the banks aren't paying any interest, and the stock market up, down, sideways, you know, who knows? And so there's got to be room for, I don't mean sell everything and buy real estate, but man, there's got to be room for a lot of people are going to be really, really impressed by your ability to explain this to them. The worksheet is great. Yes, the worksheet helps. You would do this worksheet when? Before you what? Before you buy. Yeah. When else? Before you list. You should, if you've got a listing on a rental property, you need to do this worksheet, and you need to do it before you take the listing. How many of you know people in the real estate business who've taken a listing on a rental property without really knowing any of this? And see, that's not a good idea. We need to know this stuff. Okay, and then so we use the worksheet before we buy. We use it before we list. Yeah. When else? When else? We would use this worksheet every year on the anniversary date of our purchase. Every year on the anniversary date of our purchase, we redo the worksheet and figure the rate of return on our what? We figure the rate of return, not on our investment. Our investment only matters in the year we make the investment. Every year, we figure our return on our current equity. We figure how much equity do we have and figure the return on that equity if I keep it another year. Because if I've owned a property a long time, and my equity has grown, and if I choose to keep the property, what am I doing with my equity? I'm rebuying, I say in quotes, I'm rebuying the property with my equity as the cash invested. And so every year we figure the return on our equity, what it would be if we keep it another year. And then we look around to see what we could do with that equity invested in a different property. And if we can do significantly different, it's time to what? It's time to move that equity and reload and reboot and earn your 11% or your 19, whatever it is. And so lots of you said you own rental property. If you cannot answer this question, I'm going to ask you right now, with all due respect, something's wrong. And the question is, what's your current rate of return on equity? Every year we figure the return on equity and we look around and compare what we could do with that equity. And if you came to me and said, Tom, I really need something to give my business a boost. What any ideas about just how to really give this? I would say study return on equity and show people how to do a return on equity analysis. And you'd say, can you show me how that works? I'd say, yes, I can. And you'd say, what? You'd say, great, when? And I would say, right after this 10-minute break. Take a break. 10 minutes now, 10 minutes. 2-minute warning, everybody. We'll go in 2 minutes. Let's go back to work, everybody. So you're doing great. I hope you're doing great. I hope you're having fun. I'm having fun. The worksheet helps. You got to get really used to this worksheet. It'll just serve you well if you can practice this over and over and over and explain it to people. And you know what? Practice it on a property you own. When it's your money, you really pay attention. You know, it's one thing to do the case studies, and everybody do the case studies. That's great. But if you really want to practice it, absolutely try it for a property you own or one you're thinking of owning. All right, Steve, great, thank you. That's nice of you to say. Glad you're enjoying it. The worksheet helps. The worksheet helps, and we left off saying you would use this worksheet before you buy, you would use it before you list, and then you would use this worksheet every year on the anniversary date of your purchase to calculate your rate of return on your current equity. If you own rental property, you should know the answer to this question. What is your current rate of return on equity? Every business in America figures return on equity. I have a friend who's the CEO of a big company. His entire job is to maximize the return to the shareholders' equity. And see, if you own a rental property, you are the CEO and you are the shareholder. And shareholder you ought to demand of CEO you to maximize your return. And see, the problem is we've proven it here. Typically, as your equity grows, right, as your cash invested grows, your return typically falls. And so the longer you own your property, as your equity is growing, your rate of return on that equity is falling. And so if you really want to maximize your wealth, you want to every year check to see what your return on your equity is if you keep it another year, and then compare that to what it could be somewhere else. And if in a different property, if it could be significantly higher in a different property, it's time to move that equity. And we'll talk about 3 ways to move your equity. And here's an idea for you. If you really did ask me, any tips on how to just kind of give my business a boost, I would say do this. Pick a certain area of your town, and then you go down to the courthouse, or you can do it online probably in most places, and you get all the property addresses where the property address and the taxpayer address are different. Property address, taxpayer address, different. By definition, that's a non-owner occupied property. And you send out a little postcard, or I'll tell you, you send out, I've got a newsletter for you called Does Your Rental Property Still Measure Up? And I'll give you the newsletter. We normally sell it. If you don't do it now, but if you go to my website, click on the baseball bat, there are several items back there. One of them is the worksheet, and it's not worksheet. There are the worksheets, but there's also a newsletter that says, does your rental property still measure up? And it talks about this return on equity, and it shows people how the longer they've owned a property, their return is falling. And see, people never think about that. You send out that newsletter, People are going to call you up and say, well, I got this newsletter and it says realtor, it can't be from a real estate, there's no, and they call you up and they say, what is this return on equity newsletter you sent me? And you say, well, you've owned that property a long time, haven't you? And they say, well, 15 years, I'm an investment genius. And you say, do you mind if I show you your return on your equity? And they say, well, does it hurt? No. And you'd come out and you'd show me, let's say if I'm the guy, you'd show me my return on the equity, on my equity if I keep it another year. And if I've owned that property a long time, what's that return going to be? Very what? Very low, very low, very low. Then you show me what that equity could be doing invested in that property over there, property B. And if it's way better, you'd say, Tom, you ought to list the property with me and let's move that equity over there and reboot. And then you could show me the difference in my wealth X years from now if I do this versus not doing it. It's the most powerful presentation you can make, and you'll truly have no competition, relatively speaking. I'll tell you a true story. You're seeing today and tomorrow a little bit of a 40-hour investment course that I do. 40 hours. It's 4 10-hour days in a row. It's a meat grinder. If you like this stuff, you'd love the 40 hours. If you don't like this stuff, you'd be dead after the first break. You'd hate it. But the people who get this really get it. And I was doing this 40-hour investment course. This is probably, I don't know, a dozen years ago in St. Louis, Missouri. And there was a kid sitting in the front row right there. I can just picture this kid right in the front row. His name was Matt, and it still is Matt. And Matt, no kidding, he was a kid. He was a kid back then. He had just graduated from college a month ago. He just got his real estate license a week ago, and he ends up in the front row of this 40-hour investment course. I don't know how he got there. And he's a kid. He's cocky. And I'm looking at everybody as I'm speaking. This is when, in the old days when we would do a live presentation in front of an audience. So I'm looking at everybody in the audience, and I'm looking at Matt down here in front of me, and he comes in and he's kind of, looking kind of cocky, and he sits there and he's got his arms folded, and he's thinking, come on, what am I doing here? I know everything. I graduated from real estate school last week. I memorized how many square feet there are in an acre. Well, pretty soon I start talking about this. And Matt's eyes are going, yeah, they're getting real big. Yeah. And he unfolds his arms and he realized they didn't talk about this in real estate school. And he starts writing down everything I say, bifurcate. Well, Matt didn't know anything. So he believed me. And we got all done with this 40-hour investment class. And Matt goes back to his broker's office. Broker said, all right, you're done with that stupid investment thing. Now go hold an open house and send out some recipes. And Matt says, no. Matt says, I'm going to send out this return on equity newsletter. And the broker went, I don't know what that is. Well, Matt's a smart kid. And he bought the video series. It was on cassette back then. And I do free coaching, I told you, with anybody who buys that. This is no lie. Matt would call me every day. I'm not kidding. I love this kid. He would call me every day, usually in the afternoon. He'd call up and he'd say, hey, Tom, I was driving. I was thinking about depreciation. Or Tom, I was on a date and I was thinking, how could principal reduction be taxable every year? Yeah, I said, Matt, come on. It got so bad that if 4 o'clock came in the afternoon and I'd not heard from Matt, I'd call him to make sure he wasn't in an accident or something. Well, so anyway, Matt picked a certain area of St. Louis. I don't know St. Louis. And he sent out, I think it was 100 of these return on equity newsletters. He got all the property addresses where the property address and the taxpayer address are different. So by definition, that's non-owner occupied property. And he sent out this newsletter. Does your property still measure up? Does your rental property still measure up? And so one day my phone rings in the afternoon, Tom Lundstedt. He goes, Tom, it's Matt. I said, Matt, how you doing? He goes, not so good. I said, what's wrong, Matt? He said, Tom. I sent out the newsletter and a guy called me and wants me to come and talk to him. Now what do I do? I said, no, this is good. Oh, I can't do it. He said, I can't. I'm not ready for it. Oh, you can do it, Matt. You can do it. Come on, I'll help you. Well, so anyway, Matt went out and he talked with this man, and the man had owned this property. He'd owned it for many, many, many years. And Matt showed him how much equity he has in the property today. And then Matt used the worksheet to figure the rate of return on that equity if he keeps the property another year. And it turned out to be very low. And then Matt showed him what he could do with that same equity invested in a different property and rebooting, and it was very high. And the happy news is Matt the man listed the property with Matt, and they did a 1031 exchange, which we'll talk about tomorrow. And Matt, which a 1031 exchange allows you to move that net equity from property A to property B without paying tax and reboot. And so that was, the man did it, listed the property with Matt. Matt did the exchange. And when the dust settles, Matt got paid, and he thought, this is the greatest thing ever happened. And he was proud of himself, and he should be. He should be. And he really helped this man. The man went from earning, 5% to earning 15% or whatever the numbers are. And so that's what I'm talking about. Well, a couple of weeks after the closing, that was Matt's first deal out of real estate school, the first deal he did. Well, a couple of weeks after the closing, Matt called me up, and I said, Tom Lundstedt. He goes, Tom, it's Matt. Hey, Matt, how you doing? Oh, Tom, you're not going to believe it. I said, what? He said, the guy called me and wants me to come and talk with him. Well, I said, well, so what? This is good. No, I must have done something wrong. I must have made a mistake, Matt's thinking. I said, no, Matt, you didn't. Come on, I helped you with it. You didn't make any mistake. You really helped the guy. Oh, no, I'm nervous. I say, you go talk to the guy. You go to his office and you talk with him, and then you call me and tell me what he said. Okay, all right. So that's funny. He goes, he went to the guy's office, and he called me that afternoon. Matt called me and he said, Tom, you're not going to believe it. I went to his office, and the guy's an attorney. The guy's an attorney, and he said, I went into his office, and he's at the desk, and he's on the phone. He's at this big oak desk, and there's a big stuffed fish on the wall, and he's on the phone and looking really grumpy. And Matt said, I walked into his office, and he just pointed at a chair in front of his desk, just real mean, like just pointed, sit down. And so and the man's still on the phone with somebody else, and Matt was just sitting there. And he said, oh, I was so nervous. I said, well, what were you thinking? He said, I was just nervous. I was, 43,560, 43,560. Well, finally the man hung up the phone, finished with that, and looked at Matt and said, Matt, I want to ask you a question. Yeah. And the man said, I own 41 more of these properties. Would you consider listing all of them for exchange and doing like you did for the first one? And I said, well, what'd you say? Matt said, I was cool. I paused and I said, okay. And he did. That was his first client out of real estate school. He listed the 41 more, and they did the exchange, and took that guy from earning 5% to earning 15%, or whatever the number was. And I'm just telling you that possibility exists for all of you. And it doesn't have to be 42 properties, from one guy, but you all know people who've owned a rental house for 25 years. They don't realize they're only earning 5% of their money. You might know somebody who owns 10 properties. They've owned them a long time. Show them this return on equity, and show them how to move that equity and what their new wealth will be. Does that make sense? I hope it makes sense. Yeah, because I want to find the new Matt or Mattina in this group here that we are together today. Take a look in your book. Take out another worksheet now. Take out another blank investment property worksheet. And look in your booklet on page 5, look at case study number 3. So I'm in the second handout, how to be a savvy seller handout. Look at case study number 3 on page 5. And this is roughly the numbers that of the first property that Matt did. All right, I'm on case study number 3, page 5. And so have a blank worksheet, and at the top of the worksheet, put case study number 3. Case study number 3. So if you pick this thing up a month from now and you think, well, here's the answer. What was the question? Well, it was case study number 3. All right, so let's read it together. You silently. You have a client who's owned a rental duplex for the past 16 years and believes it's a great investment. He plans to retire in another 15 years or so and use the duplex to provide a large part of his retirement income. What do you think? Pretty good idea? Yeah, beats Social Security, I'll tell you that. You offer to do a return on equity analysis for him. He's not quite sure what you're talking about, but figures, what the heck, it's free. So here's what you learn. The current value of the property is $100,000. The current loans are $42,000 at 9%, $441 a month. There's your annual rent, your vacancy, and your operating expenses. There's your interest and your total appreciation. Where would you get all this information? Schedule E. Schedule E. When you make the appointment with a guy, have him bring in his Schedule E. If he won't do it, tell him to go jump in the lake. You don't have time. The transaction cost, if you were to sell, total 8%. That's all your brokerage fees, closing costs, attorney fees, everything. And he's in a 35% tax bracket. Let's say 35%. Now, do A there. Please calculate your client's net equity. Just do it at the bottom of page 5, that white space. It's the amount he'd walk away from the closing with if he sold. Let's say I'm this guy. I could sell this property for $100,000. Do a little net sheet. Now, wait a minute. Do you need to know what I paid for this property 16 years ago? No. Why not? It doesn't matter. You're taking a picture of me when? Today. This is what I look like today. And you think, I say, come on, you should have seen me 16 years ago. It doesn't matter what I look like 16 years ago. This is it. The question is what to do from today forward, not what I should have done 16 years ago. So you don't need to know what I paid for the property. You don't need to know what my original loan was. You're taking a picture of me now. So take a moment now, and at the bottom of page 5 in that white space, figure my net equity. How much money could I walk out of the closing with if I sell this property? One possibility. Door number 1 is to sell the property. Door number 2 would be to keep the property. I want to know how much money I'd have if I sold the property. I'm going to list it with you and sell it. You do a little net sheet. Chat in your answer when you get an answer. All right, go ahead. You can do it. You can do it. Hang with me now. This will make you a lot of money. The new Matt or the new Mattina, I'm going to find you. Chat in your answer. But how much money could I walk out of the closing? I'm going to sell it for $100,000. I've got to pay off my mortgage. I've got to pay my closing costs. That's it, Stacy. No hard math, easy math. Don't let the math get you. Stand back from it now. Chat in your answers. That's it, Eric. That's it, Kurt. Daniel, that's it. You getting what I'm getting on the screen? Right, that's all I'm asking. Easy answer. Easy question. That's it, Mike. That's it, Jason. Couldn't I sell this property for $100,000? I'd have to pay $8,000 in all manner of sales costs. I'd have to pay off my mortgage. $50,000 is my net equity. Couldn't I walk out of that closing with a check in my pocket for $50,000? Yay or nay? Yay. Yay. How much money do I have invested in that property today? $50,000. Right? Because if I choose to keep the property, what am I doing with my $50,000 net equity? I'm not nothing. I'm saying let it ride on that good deal. I'm rebuying the property. Every year that you keep a property, you are rebuying it with your equity as the cash invested. You're saying let it ride on that good deal. Keep it right where it is. Well, the only way you can make a decision of whether it makes sense to let it ride on that good deal is to know the rate of return on that equity if you keep it another year, and then you compare that to what it could be somewhere else. What do I think I have invested in that property? It doesn't give you a number, but what do I think I have? I think I have whatever I put down 16 years ago. Let's say I bought it, I put $10,000 down 16 years ago. I think I have $10,000 invested in that property. No. That's what I put into it years ago. Doesn't matter what I did years ago. You're taking a picture of me today. Today, the decision is what to do with 50,000, not what to do with 10,000. That's the first hurdle you got to drag me over because I think I've got 10,000 invested. No. All right. So the first hurdle is you convince me I've got 50,000 invested. I say, oh, yeah. Then you say, let's figure out your rate of return on that 50,000 if you keep the property another year. And I say, okay. So now take the blank worksheet. Take the blank worksheet, please. Take the blank worksheet. And let's do this. Where it's purchase cost, you can leave that blank. Where it says cash invested, scratch the word cash invested and replace it with net equity. And what number goes there? $50,000. Right? Does everybody agree? I've got $50,000 invested in that property. Yeah, yeah. All right. If I keep the property another year, I'm rebuying it with 50,000 as the cash invested. And now what I would like you to do is take the information from the case study and see if you can complete the 3 parts of the money machine. And then my 4 parts, my 4 benefits and my rate of return. What's my rate of return if I keep this property another year? All right, go ahead and do it. And then what are we going to do? We're going to compare that rate of return to what I could do with that $50,000 invested in a different property. And if I can do better, it's time for me to list that property with you right now and move that equity. All right, go ahead. You can do it. Chat in your answers as you go. Chat in your cash flow, chat in your principal, your tax savings are paid, and my rate of return. You can do it. Hang with me. I know it's a lot of numbers, but this will make you a lot of money. And you can have multiple properties from one client. You know people who own 5 properties. Here's 5 potential listings for you. All right, go ahead. I'll be quiet. But do chat in your answers, please, because that's how I keep track of how fast or slow to go. All the information is in the case study. Just follow the worksheet now and think how you would explain it to people. Steve, I'm not quite sure what that number is. Double check. That's it, Eric. That's it. That's your cash flow. Yep, good. Yeah, Steve, I'm not quite sure that number you got there. Double check that. Don't forget the vacancy. I've got the 3 parts of the machine up there now. Be sure you're using those numbers. Stacy, there wouldn't be a cap rate though. You already own the property, so that. But if you were doing cap rate, it would be on $100,000. So it would be about half of what you've got there. That's it, Eric. So roll it up now. Yeah, good. That's good. So Eric, what would you have in your briefcase? Listing agreement, yeah, but you'd have another worksheet on other property that could be bought with $50,000 cash invested. Okay, Steve, so that'll make the difference. Yeah, Eric, that's for sure you'd have that. But you'd also have another worksheet to show me what I could do with that 50. That's it, April. That's it. That's your cash flow. Very good. Alicia, that's it. Good job. So just keep going, write down the worksheet. Brenda, that's a little too high cash flow. I think you might have only paid the interest, maybe. That's your principal reduction, April, Alicia, yep. Brenda, double check your cash flow now. You got to pay your debt service. And debt service is principal and interest. And be careful whether you're saving or paying tax, everybody. Saving or paying. Always be careful of that. That's it, Daniel. Take your time. Think how you would explain this to people now. Are you saving or paying tax? Yep. April, yep. Yep, good. Very good. 987 paid. So now roll it up. Tell me my return if I keep this property another year. Alicia, that's it. Mike, no, that's too much. Something's double check, Mike. Matt, that's good. You're paying tax now, Mike, right? April, it's a little too high. You're paying tax. So don't shortcut it, follow the worksheet. It's still too high, April. It should come out 7.9 or 8, depending on how far you round it. Use the worksheet now. Don't shortcut it. You'll shortcut into a wrong answer now. The worksheet tells you what to do. Use it like a roadmap. Alicia, I think you did it as if you're saving tax. You're paying tax, right? So take it away. I'm just guessing that number's too high. That's it, April. That's it. Alicia, did you see it? I think, do you have tax paid? Yeah, Sarah, I'm not sure where that number comes from. Kurt, that's it. Double check, Sarah, double check your numbers. Kurt, that's perfect. Yeah, but now Jane, look, you're saving tax. You're not this. No. He's got to pay tax, right? If the taxable income is positive, you have to pay tax. So that 987, take it away. The IRS is going to take away 987, right? So this man is not saving anything. He's got to pay. That's it, Roz. Alicia, that's it. Now you're talking. That's it, Jane. As soon as you make that change, you'll have it perfect. Right? Whenever you have positive taxable income, circle taxes paid, and the IRS is going to take that away from you. If you have negative taxable income, circle taxes saved, and that's your money. Yeah, Steve, that's all right. Don't redo it, but that's why your numbers will be a little different because you missed that $864. I want you to get the numbers right, everybody, but I care way more that you know how to explain it. You can pay somebody to do the numbers for you, or your calculator or computer will do the numbers. The skill comes in being able to talk the talk, explain it to them. All right, take a couple more minutes and I want to show you something. Yeah, that's all right, Sarah. So you got the right answer to the wrong question, Sarah. That's okay. That's all right. You got the right answer if I was in a 30% tax bracket. So that's fine. I'm going to jump back and forth from 30% to 35 on purpose, just to get people, having to concentrate, think about it. So. Let's try it together. Let's try it. And could this be a real world example? And the answer is absolutely. You know dozens of people who've owned a rental property a long time. So here I am. Let's say I'm this person. I'm this guy. I've owned this property for 16 years, and I think I'm an investment genius because I only put $10,000 down 16 years ago. But what you're bringing to mind is that I don't have $10,000 invested. I've got $50,000 invested. If I list this property with you and sell it, I'd walk out of the closing with net equity of $50,000. If I choose not to do that and keep the property, I'm rebuying it with $50,000 as my investment, my cash invested. That's the biggest hurdle you got to explain to people. All right, so now you've convinced me of that. You'd say, Tom, let's see what your return on your $50,000 is if you keep the property another year. And so you filled in the top part, and then we figure the cash flow. We take the gross operating income, which is the 13,536. Now you stop me if you're not sure where the number comes from, minus the operating expenses, 4,900. It gives me 8636 net operating income. Out of the net operating income, I have to pay my debt service, which is 441 a month times 12, 5292. So I'm left with $3,344. You say, Tom, you got 3,344 cash flow. I say, I know it. I'm an investment genius. Well, 3,344 cash flow would be genius territory on a $10,000 investment, but 3,344 on a $50,000 investment is not genius territory. The second benefit is principal reduction. We take the debt service, which is 5292, minus the interest, which given in the problem was 3716. So the difference is 1576. So not only do I have 3,344 cash flow, the tenants pay my loan down 1576. I don't get that money till I sell or refinance, but it's my benefit. My net worth goes up 1576. Now, what do we tell the IRS? Well, Roman numeral 3, we take the net operating income, 8636, minus the interest, which is 3716, minus the depreciation, which is $2,100. Now, do you need to know if, when, or how I bifurcated when I bought this property? No. Where would you get this $2,100? Right off his Schedule E. Schedule E will tell you what the depreciation is. You can take it right from there. So you don't have to do any calculating or, to figure it out or anything. Okay. So now if you make this calculation, look it over here. We take the net operating income minus the interest minus the depreciation. You end up with a taxable income, 2820. That's a what 2820? That's a positive 2820. What does that mean? The IRS says, okay, you are now making money, so we are now taking money. Circle tax is paid. You got to pay tax now. In a 35% tax bracket, state and federal, 35% of that would be $987 paid. The appreciation is zero. Say zero. What if I said, what are you talking about zero appreciation? This thing's gone up in value a ton since I bought it 16 years ago. Shouldn't that count for something? What would you say? You'd say, Tom, it's already in there. It's already in there. You don't know what I paid for the property 16 years ago, but you know today's value is 100,000. So any appreciation up till today is in there. What I'm talking about, zero, is going forward. Let's assume zero appreciation going forward. I hope it's a lot, but let's assume zero. So now down at the bottom, we figure our return without appreciation. And I add up the right-hand column. I add up 3,344 cash flow plus 1576 principal. And then I've got to pay 987. The tax saved is a negative number. I've got to pay 987. I'm left with 3933. What did I invest? What do I have invested to get 3933? $50,000. If you invest 50,000 to get 3933, that's 7.9% on your equity. You'd say, Tom, you're earning 7.9% on your equity, which is hardly genius territory. Now, what would you, the professional realtor, have in your briefcase besides a listing agreement? You'd have another worksheet on other property that could be bought with $50,000 cash invested. It might be a $200,000 property around the corner over there that could be bought with 50,000 down. And you'd say, Tom, if you keep the 50,000 invested in this property, if you keep this property, you'll earn 7.9. But Tom, if you move it over here, you'll earn 19% or whatever. I'm using 19 because that's the number we got with the first one we did this morning. Remember, the first worksheet was 19%, wasn't it? You'd say, Tom, if you keep it, you're earning 7.9. If you move it over here, you're earning 19. Hubba, hubba, let's go, move it. There are three ways to move your equity. You could sell. What's the problem with selling? Cha-ching, you got to pay tax. You could refinance. What's the problem with refinancing? Well, you're probably not able to borrow your entire net equity. Maybe you could, but you're probably not able to borrow your entire net equity. Even if you could, though, you'd be leaving so much of your old basis under that old depreciation that it's not as good as it could be. And refinancing and buying another property, it's better than doing nothing, but it's not. What's the best way to move that equity? do a 1031 exchange. Do an exchange. An exchange allows you to move your equity from property A to property B without paying tax and reboot the depreciation, rebifurcate, all that. And that's what we'll talk about that tomorrow in detail. 7.9, 7.9. Now what's the guy going to say to you? This much of my practice is return on equity. And here's what Matt did, exactly how he did. What the guy's going to say, you're killing me. If I'm this guy, if I'm this person who owns this property, I'm saying you're killing me. You're killing me. I finally have cash flow. I finally have cash flow. I need that cash flow. What would you say? Say, you don't need that cash flow. You need good cash flow. This is bad cash flow. Why is this bad cash flow? You're earning $3,300. You're earning $3,300 on a $50,000 investment. That's 6.6% cash on cash. You know, that's 3344 on a $10,000 investment would be genius territory. But 3,300 on 50,000 is not genius territory. Plus, look at this. This is not good cash flow. Why? It's not tax sheltered cash flow. I'm earning 3344. I'm paying tax on $2,820 of it. You see that? 3344. I'm paying tax on 2,800. It's not tax sheltered cash flow. Bad cash flow. You're killing me. You're killing me. I've been paying extra on my mortgage. Every month I make a little extra principal payment on my mortgage to try to get the thing paid off faster, to be like that guy on the radio says, to be debt free. What would you say? You'd say, I don't know much about this, man, but here's what it sounds like to me. If you're paying extra on your rental property mortgage, it sounds like you start out strong. You start out at 19%, and then as fast as you can, you want to get to 7. Well, that's stupid. That's just stupid. Oh, yeah. But I'm old. I'm old. What would you say? You'd say, so what? You're old. You mean you're so old you'd rather earn 7% because 19 would be too exciting? Do you agree with me that real estate involves more effort than some investments? Yeah, I think we agree with that, don't we? It involves more effort than some investments. Do you agree with me? It involves more perceived risk than some investments. Yeah, perceived risk. If you're going to go to the effort and the risk of owning real estate, you should earn the rate of return of owning real estate. And see, the problem is the longer you own a rental property, your return falls and falls and falls. Your return eventually falls to that of a government bond. If you're going to go to the effort and the risk of owning real estate to earn the return of a government bond, no offense, but that's crazy. That's just nuts. You can't defend that with your head. You can convince, you can justify it with your heart. Your head says, come on, what are you doing? Listen to this guy, move that equity. Your heart says, no, come on. It's the first one you ever bought. Mabel in apartment 7 makes you brownies when she pays her rent. Keep the property. Well, if it becomes a decision between your head and your heart, what will win every time? Your heart. And people go their whole lives investing with their heart. And then at the end of their life, what does their heart say to their head? What did you listen to me for? I don't know any of this. I didn't even graduate high school. I got a phone call from a guy. This is 3 years ago now, probably. He's a realtor, a real estate broker in San Luis Obispo, California. And he had bought my video series. And he called me up, and nice guy. He said, hey, Tom, would you mind talking with one of my clients? I said, sure, put him on. Well, we went on a 3-way conversation, and the client's a real nice guy, and the broker's a nice guy, and I'm okay. And this client owned $5 million worth of really nice AAA, that's top condition, top location, top tenants, AAA office warehouse type property. You know what I mean by office warehouse? $5 million worth. And I said to the client, I said, do you happen to know your return on your equity? He said, I sure do, 100%. I said, wow. He said, yep, I own it all free and clear. I said, can I call you back? And I got some numbers from the broker. And that night I did a little work, and I called back the next day, and we went on the 3-way conversation again. And before we started, I said to the client, look, I just want you to know, I'm a real estate broker in Wisconsin. I heard about this great property. It's so good. It's so good. I'm offering it to you. If you buy it, you'll earn 4.2% on your money. What did he say? He said, I wouldn't touch a property like that with a 10-foot pole. And I said, you already own it. That's what he was earning on his $5 million net equity, 4.2%. And we showed him how to move that equity. And the broker exchanged him out of the 5 million into 15 million. And now he's earning his 19% or whatever it is. And it doesn't have to be $5 million. It's the same concept as with $50,000. You all know people who fall into this. So just think about how you could explain this to people. What if I said, you're killing me. You're just killing me. And I said, well, can I show you one more thing? I said, okay. And he said, look at this. If you just decide to keep the property, you might say to me, Tom, if you keep the property, what am I doing if I keep the property? I'm rebuying the property. I'm investing it at 7.9%. Remember, this guy wants to retire in 15 years. If I keep this property, I'm investing the 50,000 at 7.9 for 15 years. That presumes I can maintain the 7.9. What's really going to happen? It's going to get weaker, but let's at least presume. Do you know what that grows to? Grows to $156,000. Not bad. I'm not saying you made a mistake. You're way better than a guy who didn't buy any real estate. But what if you could show me how to move that equity? What's the best way to move that equity? Do an exchange. Could I move that equity and earn 19% over the next 15 years? I'm using 19 because that's the number we got with that first one we did this morning. It's not always going to be 19, whatever it is. Now, in order for me to maintain that 19%, what am I going to have to do over the next 15 years? I might have to move my equity again, move it again, move it again. I might have to move it 3 or 4 times in the next 15 years. Well, how in the world am I ever going to know when is it time to move the equity? You, the professional realtor, are going to be calling me every year on the anniversary date of my purchase and say, Tom, it's time to do that return on equity thing again. If I can maintain that 19%, do you know what that grows to? Look at that. Look at that. This is not little money we're talking about here, kids. This is big, big money. And this is on a credit, or not credit, but this is on $50,000 net equity. This is on 50,000. Some of you might have 500,000. Some of you might have 5 million. Run the numbers on that and see what you get. Look at the power of this. Now, I've got a really important question for all of you. I would never ask this question in a pre-licensed class. Those people would never get it. But this is GRI. This is good. This is better. This is good. This is better. This is what our wonderful business is really all about. Take a break, 10 minutes. Take a break.
Hey, Tom, I got flying buckets I need to go outside and get quick.
Oh yeah, that's wait, what do you have to go outside and get?
Like, I have these 5-gallon buckets and they're just flying around all over. The wind really picked up.
Oh, all right. I thought you got chickens running around though. You go out there. We're fine. We're just fine.
They're pinned up, but my buckets aren't. But I'll be right back.
All right, no sweat.
Okay.
10 minutes, everybody.
Tom, I have a quick question for you.
I'm here, Matt. I'm back. Happy to answer any questions.
Do you use any, just generalities like on repairs? You know, that can vary so much depending on the age condition.
Matt, I'm not hearing you very well. I can hear you talking, but I can't understand you. Say it again.
Hold on here. For repairs, that seems to be like one thing that's can have quite a variability.
Yeah, absolutely.
Based on condition of property, I guess you try to use some generals of thumbs, you know, use what they've been paying,
Well, yeah, I mean, not what you
use
You
averages.
got to kind of look at, yeah, if you have enough property, there will be averages, but if you only own one, that's the average. So you got to really sharpen your pencil and say, what the guy's going to say is, hey, Matt, I buy this property. I haven't had to repair anything for 5 years. Well, it's all going to break the next year,
Yeah.
and you might go 1 year with nothing and the next year with a lot.
Next
So
year, you get
that's
8 grand
why
in HVAC. Yeah.
Depending on the type of property, kind of the overall expenses. Remember I said that operating expense ratio ought to be somewhere 45 to 50% on an apartment building. We just kind of automatically use 50%.
What about
And-
single family?
Well, single family is different because then it's
Like
going to
30, 35 maybe?
Well, I wouldn't even say it. I don't know the property tax situation in Nebraska.
It's horrible.
Did you say bad?
Yeah, it's well 2% of value basically.
Okay, all right. Well, so factor that in, and you'll be able to look at averages. I think the other thing is with a single family house, a lot of times I had the tenants pay the first $35 of each and any repairs or maintenance. It's like an insurance deductible, and that worked really well.
And they usually pay all the utilities too. So
They pay all the utilities, yeah, for sure, all the utilities. And so, a part of it is you just got to go with your gut feeling and be conservative with your numbers. You can make these things look really, really good if you fool yourself enough. So you want to be as accurate as possible. But a house, I've owned lots of houses, and there aren't people think, oh, the roof is going to blow off, or the furnace is going to explode. It doesn't. On average. As soon as I say that, the furnace will explode on your next rental property. But just be conservative with your numbers. That would be my best advice.
I just did two of the properties I have. Kind of entered your worksheet into a spreadsheet, whatever, and
Yeah.
just amazing. I didn't really look at operating income to equity, and I got one that's 11, one that's 20. I'm like, okay, well that's.
You mean, now are you doing your return on equity?
Yeah.
Yeah, you got all this equity in there. You got this money. What could you be doing with the money? Now, it might be that you look around and think, I can't do any better. Then keep it with confidence. You can't do any better. But if you can do better, you sound like a young guy, it's going to make a huge difference in your life.
Yeah, I wish my runway was longer.
Yeah, don't we all? All right. Well, I'm glad you're interested. And that's the way to do it, is compare it to, or use it with your own situation. That's where you really learn it. All right. 2-minute warning, everybody. We're going to go back to work.
Please, I want to see you. Please. Please, help. Want to see you.
Do you have to go potty? It's wet out there. You want to go?
No, I don't have to go potty. I just want you to know you're.
Oh,
muted.
sorry.
I just thought I'd let you know before you said something weird.
Well, that was weird right there.
Well, it could have been weirder.
Thank you.
You're welcome.
All right. We're going back to work. Got to go back to work. This is great. Several of you have contacted me over the break. You can see a use for this stuff. Yes, I hope so. I really hope so. And I'll bet you every one of you can think of somebody who's owned a rental property for a long time. Somebody who's owned a rental property, same rental property for 12, 15, 20 years, and they don't realize they're earning 4% on their money. They're only earning 4% on their money. And so one question would be, hey, I've got a great investment for you. You'll earn 4%. It's you're crazy. I wouldn't buy it. The answer is you already own it. Show them this. So I want to try one. I want to really cement this in your mind. Get another blank worksheet, investment property worksheet, and turn to page 6. Case study number 4 on page 6. So at the top of the worksheet, put case study number 4, page 6. All right. And then let's read this. Your Uncle Louis is an investor who's owned a rental house for the past 30 years and believes it's a great investment. He likes to boast about the great return he's earning on his original $15,000 down payment. Louis plans to retire in another 15 years or so and use the rental house to provide a large part of his retirement nest egg. And you offered to do a return on equity analysis for him, and he's not sure what you're talking about it, but he also figures what the heck, it's free. Now, here's what you learn. The current value of the house is $120,000. His loan is zero. He's paid it off. His current rent is $1,100 a month. For vacancy, let's use 1 full month. Because if you're a little vacant in a house, you're probably going to be vacant the whole month. Maybe not. And there are your operating expenses listed. And the total depreciation, there is no depreciation. He's depreciated this down to nothing. The transaction costs, if you were to sell, total 8%, and Louis is in a 35% tax bracket. Would you do me a favor before you go to the worksheet at the bottom of the page, do a quick net sheet. Here, if I'm Uncle Louis, I could sell this property and walk out of the closing with how much money? Just do a quick little net sheet. Door number 1 is sell the property for $120,000. How much money could he walk out of the closing with? Yeah, are you getting 110,400? Right? No hard math. He could sell it for 120. He's got to pay 8% in cost of sale. And that leaves him 110,400. How much money does Louis have invested in this property today? 110,400, right? Because if he says, no, I'm keeping this property, then he's rebuying it with 110,400 cash invested. All right, so that's the first hurdle. You got to get him over. He's going to be mad at you now. But now, would you do me a favor and see if you can complete the worksheet? And if I'm Uncle Louis, tell me my rate of return. And I'll leave the answers. I've got the answers up on the screen. Now, don't just copy the answers. That's not fair. But work a couple lines, check the answer. Work a couple lines, check the answer. Because it's one of those deals. If you make a mistake early, you carry it all the way through. If you can do this, you are a junior Matt or Mattina, and you've got the ammunition to really build a business. I think on return on equity. All right, give it a try. Give it a try. All the information is in the case study. Think how you would explain it to Uncle Louis or to anybody. And I'm going to be quiet now. You work. Chat in your answer when you get to them. Even though I've got the answers up front, that just helps me know how fast or slow people are working. All right, go ahead and try it. Think how you would explain it now. And if you're not sure where a number comes from on the, as you're double checking, let me know. Yeah, Eric, that's it. Sarah, good. Yeah, Eric, good. Mike, it's a little too high. Be careful whether you're paying tax or saving tax now. Alicia, yeah, I think that's good, Alicia, depending on how far you round it. Mike, it's Brenda, the net equity, we sell it for 120,000 and pay 8% in costs. Right, so subtract the 8% from the 120,000. Mike, that's too low now. A little bit, I mean, it's close. Yeah, Matt, that might be a little too high. I gotta check my own math. Check against what I've got on the screen. Jane, that's it. That's it, Sarah. Yeah, Sarah, that's it. That's perfect. That's it, Jane. Now that's your tax paid, Jane, right? And then, yeah, perfect. You're 5%. It ought to come out around about 5%, everybody. Check the screen. I've got the answer up on the screen. Yeah, there you go, Matt. Yeah, we took a whole month out for vacancy. Check this, check the answer. You're not cheating by checking. I want you to check. And think how you would explain this to Louis. Yeah, I'm with you, Alicia. Sarah, that's it. It's the universal language, Alicia. Think how you would explain it to him. Because he thinks he only has, hardly anything invested in this property. He thinks how great he's doing on his original investment. He only put 15,000 down. But that doesn't matter. It doesn't mean anything. You know, Kurt, you got a good point. Once things are depreciated out, it's time to move. It's probably time to move way before that. That's why people say, well, what's the average time to move? You might be in a market that's appreciating really fast. Your equity is growing fast. What that means is your return is falling fast. And so it might be after 2 or 3 years, it's time to move that equity. Or you might be in a market that's just really steady, but not, not booming. And it might be you hold that property for a long time because you can't do any better. That's why every year, just see what you're doing now and compare it to what you could be doing. And if you cannot do any better, significantly better, it's time to then keep the property, but keep it with confidence. Good. Thank you, Alicia. Thank you, Sarah. Take a couple more minutes. Think how you would explain it. For practice now, when you go home tonight, or you're at home, probably a lot of you, try explaining it to somebody. What, Matt, you got to give me an example like that.
Hopefully it's okay if I unmute here real quick. Could I own the same duplex, sell it, and then rebuy it 5 years later and apply all the cost recovery to it again?
Well, yeah, I mean, they have what's called economic justification. You can't sell it and buy it back the next day just to get a higher basis. And what you'll see when we're going to talk about what happens when you sell, that it wouldn't make sense anyway, because in order to increase your basis, you'd have to pay tax on your gain. If you could justify it economically, probably the answer is yes. I know of no situation where they say, no, you can't do that. But if you do it and if it smells like a dead fish, it's a dead fish. They're going to say, hey, I don't know what's going on here.
I guess my question would be, what's to stop two investors from trading the same two properties back and forth every 5 years?
Yeah, I'll show you. I'll show you. It would make no sense.
Okay.
You're going to be with me tomorrow, right? Right?
Yes, sir.
Tomorrow we're going to talk about why that wouldn't make any sense, because what it would cost you to do that. Stacy, I would say get yourself a little, look at April, there you go. Well, April, what'd you pay for that 10B? Like $30 or something like that? The online amortizations, are they accurate? Yeah, but they round too much and there's not enough flexibility. April's got a real good calculator. That's your 10B, right? You can get a good financial calculator truly for $30. Oh, you got it on an app? Okay. Let's go back now. Let's finish this up. Here's Uncle Louie. He's got 110,400 invested. If he keeps the property, he's got 8446 cash flow, 0 principal, and then he's got 0 interest, 0 depreciation. So he's got to pay tax on the whole 8446, and he's in a 35% tax bracket. 35% of that is 2956 paid. And so the bottom line is 8446 cash flow, 0 principal. He's got to pay 2956. So he's left with 5490. He's got 110,400 invested. He's earning 5% on his money, which is hardly genius territory. So you'd say, Louis, you ought to consider moving that equity and rebooting. And that's what we'll talk about, how to do when, why, and how to do a real estate exchange. We'll do that tomorrow. So this is great. Return on equity is terrific. Now I've got a question for all of you. I've got a question. Here's don't even look in your book, but let me go back to here's the first thing we did this morning. That's the first worksheet we did this morning. Remember, you all did that and you did great. And we got it was a $409,000 property, and we got 19% return. That's a 19% return before any appreciation, 19%. Here's my question to you. Would it be fair to say that that's 19% after tax? What do you think, fair or foul? 19% after tax. I think you got to be careful. I think it's curving down the foul line. I think at the last minute it goes foul. And here's why. Is it after tax for this year? Yeah, it's after tax for this year, right? Because what does this guy tell? He tells the IRS he lost 9260. So it's after tax for this year, but what? It might not be after tax forever. And here's why. This depreciation is wonderful while you own the property, but it's not a one-way street. When you buy a rental property, the IRS says, hey, climb on the depreciation bus. Climb on the depreciation bus. And you climb on that depreciation bus. And they say, take this depreciation. You say, oh, all right, this is fantastic. I take all this depreciation. I saved all this tax. And let's say you own that property for 10 years. You ride that depreciation bus for 10 years, taking all this depreciation, saving all this tax. You think this is fantastic. At the end of 10 years, you decide to sell the property. Selling the property is jumping off the depreciation bus. And how does the IRS feel about you jumping off their depreciation bus? They don't like it. They don't like it. They don't like it. So look at it. Here you are. You buy, let's say it's Maggie, my friend Maggie. Maggie buys the property. She climbs on the depreciation bus, takes all this depreciation for 10 years. At the end of 10 years, she decides to sell the property. So she pulls a little rope on the bus because selling the property is jumping off the bus. And the bus driver pulls over to the side of the road and lets her off. And she's standing in the middle of the highway with her little suitcase. And she's thinking, what a fabulous 10 years that was. I got all this depreciation. I saved all this tax. Fantastic. Well, and she watches the depreciation bus pull ahead into the sunset. Well, the depreciation bus does not pull ahead into the sunset. It pulls up the highway about 45 yards, stops and turns around to get a running start. And here's Maggie looking at the front of that big old depreciation bus at that big old bus driver who's been her friend for 10 years. The guy gets a big smile on his face and aims that bus where? Right at her and floors it. And could that depreciation bus come right back at her, smack her right in the face? Could it come back at her, smack her in the face and back up, back and forth to make sure she's clobbered? Yes, the depreciation bus comes back at you, but it only comes back at you if you what? If you sell. If you don't sell, it does not come back at you. If you hold the property until you die, what happens? Then the bus driver pulls over the side of the road and just dumps you out on the road. Never comes back at you. If you die, what happens to your gain? It dies with you. This depreciation, the depreciation bus coming back at you, what do they call that? What does your accountant call that? That's called depreciation recapture. Have you heard that term, recapture? Recapture is an accounting term, not a zoological term. The depreciation bus comes back at you, but it only comes back at you if you sell. If you don't sell, it never comes back at you. So what if Maggie said, well, hey, isn't there some way I can make this 19% an after-tax number? What is one answer? Die. Now picture yourself giving that listing presentation. I'm not sure anybody's going to sign up for that, and they're darn well not going to pay you a commission. So we need to talk about what happens when you sell. When you sell your property, you pay tax on your what? On your gain. Your gain. What do most people think they pay tax on? They think they pay tax on the sale price. No, that's not true. That's not true. Turn in your book now to page 7. To page 7, please. Page 7. All right. And we got to talk. I've got two formulas there. It says calculating your taxable gain. You pay tax on your gain. Let's talk about what happens when you sell. Your gain is always figured from your basis, and your basis can be adjusted up and down. And so look at the formulas I've got there for you. Your adjusted basis is nothing more than the blank plus the blank minus the blank. What words go in those blanks? Let's fill in the words. The adjusted basis starts with the original cost. So put original cost, not original price, original cost. What does the original cost include? The original price does not. Closing costs. Closing costs. Original cost. Then over the years, we get to add certain things to that cost. What? Improvements. So plus the improvements, any improvements you make are added to your cost, added to your basis. That increases your basis. Then there's something that reduces your basis, subtracts from your basis, depreciation. Original cost plus the improvements minus the depreciation, that equals your adjusted basis. But we do not pay tax on the adjusted basis. We pay tax on the gain. And the gain is the blank minus the blank minus the blank. What goes in those blanks? Well, it's a sale price, right? Just the price you sell it for, the sale price, minus the cost of sale, minus the cost you still have in your property, which is your adjusted basis. That equals your gain. It's just that simple. You cannot figure your gain without knowing your basis. You cannot figure your basis without knowing your depreciation. Now, what word is not in here? What word is not up there? Well, a lot of words aren't up there, but what word is not up there on the screen that people think ought to be up there? Mortgage balance. Nowhere up there does it ask you the balance of your mortgage. Why not? Your mortgage has nothing to do with your gain. Your mortgage has to do with your equity. And equity and gain are two different things. See, what do most people think they pay tax on when they sell their rental property? They think they pay tax on the amount of money they walk out of the closing with. But see, that's your equity. There's no tax on equity. The tax is on gain, and gain and equity are two different things. They're not even going to ask you the balance of your mortgage. If you don't have a mortgage, you figure the gain the same way. If you have a giant mortgage, you figure the gain the same way. Okay? Now, with that in mind, gaze your eyes downward on this page 7 and look at case study number 5. Case study number 5. And let's read it. Several years ago, you purchased a small apartment building for a cost of $400,000. After many years of ownership, you sell the property for $650,000. Your cost of sale is 8%. Your mortgage balance is $240,000. And you took a total of $98,000 in depreciation over the years. Would you do me a favor and please calculate your adjusted basis, your gain, and your tax? Assume the gain will be taxed at 25% combined state and federal. All right, so here's what I want you to do. Figure your basis and figure your gain. Now, what would most people think their gain here is? What would most of America think their gain is? Most people would read this and go, I can do this in my head. I bought the property for 400. I'm selling it for 650. 250,000 is my gain. Is that right or wrong? That's wrong. Now you tell me what it would be. Assume we made no improvements, just to make our numbers easy. No improvements. Now I'm not suggesting you can own a property for years and not improve it, but just to make our numbers easy. Tell me what is my adjusted basis, what's my gain, and what's my tax? All right, go ahead. You can do it. I know you can do it. Don't shortcut it. Put it right into this little formula. That's it, Stacy. No, now pay the tax. The tax is 25%. Average is 25%, say. So take 25% of that. So yeah, chat in your answers as you go. Stacy, that's perfect. Yeah, yeah, absolutely. So the question is, if I've owned a property for many, 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 many years, should I keep track of the improvements? Yeah, if you don't, you're going to pay way more tax than you have to pay. So yeah, that's absolutely. Alicia, I'm not sure what that number is. Don't shortcut it. Put it right into the little formula I've got up here. The formulas. We're saying no improvements. Yeah, you got to have receipts. You got to be able to prove it. If you don't prove it, you didn't do it. In the eyes of the IRS. Yeah, Eric, that's good. That's it. Jane, that's it. How do you think I feel about that?
Happy.
Yeah, Matt. Or died. Yeah, Brendan, now pay the tax. The tax is 25%. Can we try it together? Yeah. All right. So now this guy thinks he's got, he thinks he's got it all figured out. He doesn't. The first hurdle you got to get me over is I've got to figure my adjusted basis. We take the original cost, not the original price, the original cost. Remember the cost includes the closing cost. My original cost was 400,000 plus the improvements, 0. Now, again, I am not suggesting you can own a property for years and years and not improve it. But just to get the idea. So the question is absolutely, we should keep track of our improvements because they will increase our basis and ultimately reduce our gain, which reduces our tax. So original cost, 400,000 plus the improvements minus any depreciation you took, which is 98,000. Now this is the depreciation I took during what period of time? The whole time I owned it. The whole time I owned it, 98,000. If you do that calculation, did you get $302,000 as my adjusted basis? Yep. Give me a two-word synonym for adjusted basis. What we in real estate, we have our own language. What does every other business call adjusted basis? 2 words, you've heard them. You've heard them. I guarantee you've heard them. Most businesses call the adjusted basis their what? BV. Book value. It's your book value. Have you heard that term before? Your book value? It's the value carried on your books at. Has nothing to do with the market value. This is the value carried on your books at. We call that the adjusted basis. All right. But we don't pay tax on the adjusted basis. We pay tax on the gain. And the gain is the sale price, which in this case is 650,000, minus the cost of sale, which totaled 52,000, minus the adjusted basis, $302,000. If you make that calculation, you end up with a gain of $296,000. $296,000 is your gain. Is it taxable? Yeah. State and federal average is 25%. 25% of that is $74,000 in tax. You'd say, hey, Tom, you got to pay $74,000 in tax. How do you think I feel about that? Not happy. I was happy till I met you. I'm especially not happy if I'm the guy who, like he said to me one time, when I said, what tax bracket are you in? The guy said, I don't pay any tax. I said, you're kidding. He said, nope, I always get a refund. Well, what does he think he's getting back? His own money. $74,000 in tax. I think this is terrible. This is terrible. But you know what? You know what? There is no way this is right. No way, man. Because look at this. Read the case study, will you? It says right here that I have a $240,000 mortgage on this property. I've got a $240,000 mortgage. You never even took that into account. What would you say? It doesn't matter. It doesn't matter. Your mortgage has nothing to do with your gain or your adjusted basis. Your mortgage has to do with your equity. There's no tax on equity. The tax is on gain. And gain and equity are how many different things? Two. How are they related? They're not. They're not. What if I did not have? I had no mortgage on this property. Now what's my gain? $296,000. What if I had a giant mortgage on this property? Now what's my gain? $296,000. Your mortgage has nothing to do with your gain. You're killing me. You're killing. But this, this still, it cannot be right. It just cannot be. I cannot have a gain of $296,000 when the thing only went up $250,000. Look at this. My cost was $400,000. It only went up to $650,000. It only went up $250,000. I can't have a gain of $296,000. I'm going to a different realtor. You'd say realtor. I say, I don't care what you call it. I'm going to somebody else. What would the story be somewhere else? Same story. Same story. How can I have a gain of $296,000 when the thing only went up $250,000? Will you tell me that one? Do you smell bus fumes? This is the depreciation bus coming back at us, you see. Now, do you agree with me that this explanation is pretty IRS-y? Yeah, this is a little more IRS-y than most people want to get. I want to show you how to explain this to people so they really understand it. But look at this. You never have a gain unless you what? Sell. If you don't sell, you don't have a gain. So what if I didn't sell? What if I kept this property until I die? What happens to the gain? What happens to that $296,000 gain? If I hold this property till I die, the gain dies with me, never taxed, ever, ever, ever. It's forgiven. You think, well, okay, wait a minute. What about the estate tax, the inheritance tax? And you see, you are confused because your estate tax is on your equity. Your gain dies with you and your equity goes into your estate. And you can have how much equity today before there's any estate tax? It's over $11 million. $11 million. So if I hold this property till I die, the $296,000 gain dies with me, never taxed, and you, my cousin, inherit this property at the $650,000 value, and you get to start depreciating it. It's as if you bought it for $650,000. So when I say, isn't there something I can do about this? What would you say? Die. Now, we're all going to die anyway. Wouldn't you feel a lot better about it if you died, knowing you'd never paid any tax and your family's not going to do it? Yeah. What if instead of dying, what if I give you this property? What if I'm an old geezer? I'm an old geezer, old. I'm 110 years old. I'm in the hospital. I'm not doing so well. I hurt my leg jogging. And you, my long lost cousin, you hear I'm in the hospital, you come to visit me. I haven't seen you for 40 years. You walk into the room, I look across, I say, who the heck are you? And you say, Tom, it's your long lost cousin. I say, where you been for the last 40 years? And you say, oh, I've been really busy. I say, I'm so touched that you would come to visit me like this, that I'm going to give you my shopping center. I'm going to give it to you. I'm going to deed it to you. Do people do this? Yeah. If I give you this property, what is your basis? If I give you this very property, what is your basis? You're stepping into my shoes. If I give you this property, my basis becomes your basis. So you are stepping into my shoes. Could you sell the property the next day for the $650,000 and you now have the $296,000 gain? You now have to pay the $74,000. So now, if I give you this property, what do you want? You're stepping into my shoes. You need to know what size shoes I wear. You need to know what I paid for this property years ago. You need to know what my improvements are. You need to know what my depreciation was. Because if you can't prove it, you have no basis, zero basis, and your gain when you sell, it's all gain, your move. And you say, but what about my cousin Tom's basis? They say, prove it. The burden of proof is on whom? It's on you. So strictly from a tax standpoint and no other, would you, my cousin, rather I give you this property or die? Die. Die. Because if I die, the gain dies with me and you start out as if you bought it for $650. If I give it to you, you have to pay tax on $296,000. This is absolutely why at Thanksgiving dinner, I never take the first bite. You take the first bite, I want to make sure. $74,000 tax. I think, oh man. Can I show you how to explain this to people so they understand it? Here, watch this. When you sell your property, you pay tax on your gain. Okay, I know that. Your gain is made up of all the appreciation you got. Well, I know that. Everybody knows that. What people forget is besides the appreciation, what else goes into your gain? The depreciation. How much depreciation did I enjoy? 98,000. See, look at this. The appreciation, it went from 400,000 to 650. That's 250,000. The depreciation was 98,000. That goes into your gain. See, what people forget is on a rental property, the entire appreciation family, and go into your gain. Between the and the depreciation, the IRS says, okay, that's your good stuff. Now, from the good stuff, you get to subtract the bad stuff, which to the seller is the cost of sale, $52,000. If you make that calculation, there's your $296,000 gain. That'll work every time. Your gain is nothing more than all of your plus all of your and subtract the cost of sale, $296,000. Does this make sense? Yeah. What people forget is that depreciation bust. What if I said, okay, I knew all this. I didn't take any depreciation. I knew that depreciation would come back at me, so I did not take any depreciation on this property. Can you do that? Do you have to take depreciation? No, it's totally up to the owner whether they want to take depreciation or not. But you should remember this. If you're eligible to take depreciation and you choose not to take depreciation, when you sell, they tax you as if you took it anyway. Think about it. Think about it in the bus vernacular. If you have a ticket to get on the depreciation bus, do you have to get on the depreciation bus? Nope. But if you have a ticket to get on the depreciation bus and you choose not to get on the depreciation bus will just follow you around and run you over anyway when you sell. I can think of no circumstance where it makes sense not to take the depreciation. Take it, generate the loss. Even if you don't need the loss, you can carry it forward to be used in the future. 296,000 is my gain. What is that gain made up of? And How much of it is 198,000? How much of it is 98,000? You see, you have to take the cost of sale off the You cannot take the cost of sale off the So the depreciation is 98,000. The appreciation after the cost of sale is 198,000. So you have to take the cost of sale off the Now, if you think about it, does it really matter whether you take the cost of sale off the or the It does, because the and the are taxed differently. All right, now hang with me now. I know you could live long and prosper without knowing this, but this is really important. This is really important. The reason this is important is these are taxed differently. What is the depreciation made up of? The depreciation is made up of the building, the land improvements, and the personal property. The appreciation is the land. And remember I said earlier, when you sell your property, you pay tax on your gains, plural. Each of these four things is taxed differently. The land is taxed at 0, 15, or 20%. The building and the land improvement depreciation is taxed at 25% max, and the personal property is taxed at 37% max. Is taxed as ordinary income and could rise to that. Now, this is just This is only federal. Besides the feds, you got to pay the state. So look in your book now. Look in your book and you see where it says capital gain tax rates. I'm halfway down page 7. We'll fill in the blanks and then we're going to call it a day here in a little bit. So we're rounding third, heading for home. Hang with me now. Let's read it. Capital gain tax rates for sales of long-term capital assets held longer than 12 months. So put longer than 12 months. The maximum federal capital gain tax rate now is put 0, 15, or 20%. 0, 15, or 20%. It depends on how much money you earn. So the maximum is 20%. Hang on, Steve. I'm with you. I'm with you. All right. So 0, 15, or 20%. And a lot of times people think, okay, I'll just pay the 20%. Oh, we got to keep going here. However, any portion of the gain resulting from depreciation deductions on real property, underlying real property, is taxed at a maximum rate of 25%. So the building and the land improvements are real property. They would be taxed at 25%, recaptured. Remember, the depreciation is recaptured. And then the next sentence, any portion of the gain resulting from depreciation deductions on personal property is taxed as ordinary income and could rise to a maximum rate of 37%. Now, all these percentages are just the federal. Besides the feds, you'd have to pay wherever the state of Nebraska would be. All right, so look at this. The gain on the land is taxed at 0, 15, or 20. The depreciation on the building and the land improvements is recaptured at 25% and the personal property at 37%. Therefore, what would I, as a seller, rather have? $1 of gain from or duh? Is better than duh. When you go home tonight and somebody says, what'd you learn in that lame class you went to today? What are you going to say? Is better than duh. They'll say, man, sorry, I missed that. But is better than duh. What do you, as a seller, have limited ability to control how much of your gain comes from and how much comes from duh? What's the word? What's the word? Remember the word way back this morning. Seems like a long time ago, doesn't it? Doesn't it seem like a long time ago? What's the word? The word is bifurcate. Bifurcate. What does bifurcate mean? Separate. Where's the best place to separate? On the purchase contract. Where's the only place the seller can separate and bifurcate? On the purchase contract. Let me show you why. You don't even have to write this down. Just put your hand on your chin and think, okay, all right, this sort of makes sense. I'm getting a headache, but it sort of makes sense. Let me just show you a quick little example. Just a quick little example. Let's say you buy a rental property that has $20,000 of personal property in it. You depreciate the personal property over 5 years. So after 5, you've owned it for many years, you've depreciated $20,000, your adjusted basis is 0, right? Now, if I go to sell this property, this whole big property that includes the personal property, I will be treated as if I sold the personal property for $20,000. So read the blue part. When you sell, your tax as if you got your money back, unless you say otherwise. Well, I don't know any of this stuff. My accountant doesn't know any of this stuff. And so I just sell the property. If I sell this property without doing anything, I will be treated as if I sold that personal property for $20,000, right? I got my money back. My adjusted basis in that personal property is 0. My gain in the personal property is 20,000. That gain, that 20,000 will be recaptured. That gain came completely from depreciation, which would be taxed at 37%. That's $7,400. Now I want you to tell me one sentence to put in my purchase agreement and save me up to $7,400. How many of you have ever heard and seen an attorney put language in an agreement that says something like, it is agreed the personal